A.M. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
That's right. Good morning, everyone. Stocks are trading near record highs as we head into a pivotal week. Investors will get the latest reading on inflation Thursday with the June CPI print, and we're looking to the back half of the week for the start of another earnings season. So let's get to it with the three things that you need to know this Monday morning. Yahoo Finance's Jared Blickery, Madison Mills, and Rick Newman have more.
That's right. Stocks are trading near all-time highs as we head into a busy week. Big tech and optimism over improving inflation have pushed the S&P 500 and the Nasdaq higher of late. Investors will see if there's more room to run following another read on inflation, consumer price index print out Thursday, followed by wholesale prices on Friday. These numbers are going to give investors a clearer picture around the timing of a rate cut with about 3 weeks to go until the Fed's next policy decision. The vast majority of traders believe we'll see that first 25 basis point cut in September. We're also going to be watching semiannual testimony from Fed Chair Jerome Powell to Congress on Tuesday and Wednesday.
And Boeing has agreed to plead guilty to a criminal fraud charge surrounding two fatal 737 MAX crashes from back in 2018 and 2019. This comes after U.S. prosecutors said the plane maker failed to comply with the 2021 settlement agreement over those crashes, which left 346 killed. Boeing will pay over $243 million in fines and invest over $450 million in compliance and safety programs as part of that charge. Boeing shares are off nearly 30% so far year to date.
And finally, President Biden faces a tough week in Washington amid growing calls for him to step out of the presidential race weeks before the nominating convention. The latest doubts about his candidacy reportedly coming out of a call with high-ranking Democratic leaders over the weekend. This comes more than a week after Biden's weak performance in the first presidential debate. Biden downplayed concerns about his age and health in a sit-down interview with ABC on Friday night, saying he was exhausted the night of the debate. He reiterated he is not dropping out of the race. This week, all eyes will be on Biden's performance as he hosts a 3-day NATO summit in Washington, D.C.
Wall Street is gearing up for a busy week. Stock futures relatively flat after stocks closed near record highs last week, the first week of July and of the second half and of the third quarter. And inflation is now top of mind. With job growth starting to slow, investors looking to Fed Chair Powell and the release of June's CPI, that consumer price index that's due out Thursday, to see whether the Federal Reserve could potentially cut interest rates in September here. Of course, that is the probability, the earliest probability that we're seeing that's leaning towards the side of a potential cut. And then you look out to later on this year and what that could look like for December. That still stays in the mind of investors as of right now, though.
Yeah, we certainly have. So now we have the economic calendar up. If we could flip over to the earnings calendar, because that is really what is also front and center for investors this week as they digest the latest numbers on inflation, exactly what that means for the Fed. Of course, the eyes are also going to be on earnings results, the health of corporate America, just what we are seeing there. And it really kicks off on Thursday with Delta, PepsiCo, and then Friday when we start to hear from some of those larger banks. And Brad, I have a chart up, if we can throw it up here, just about the earnings growth and some of those expectations going into this quarter and then beyond. And you can see that spike of 8.8% here in the second quarter, but then look out into the fourth quarter of the year and into 2025. You have this viewpoint that has really been driving the markets now, that we have this higher bar that these corporations are going to have to clear. And if last quarter was any, signal of what we could see in terms of those reactions, the companies that did beat the street's expectations there only outperformed the S&P the following trading day by an average of 3 basis points, which is well below the historical average there. So you talk about a high bar there for corporations and exactly what they need to meet and exceed this earnings season. You got to question how big of a driver or how big of a lift to the upside maybe we will see the broader market on the heels of these earnings results.
Yeah, the top 3 companies by market cap reporting this week, representing over $1 trillion of companies that are set to report. JP Morgan, PepsiCo, and Wells Fargo, those top 3. Of course, you got a host of names, even as we were taking a look at the calendar and some of those logos, household names like Delta, like Citigroup, Bank of New York Mellon, BNY, of course, and then additionally, you've got Conagra Brands. But 2 interesting stats from the folks over at FactSet that really came to mind and jumped out to me in in this most recent report for the earnings growth front. For Q2 2024, the estimated earnings growth rate for the S&P 500, 8.8%. Now, if that's the growth rate for the quarter, guess what? It's going to mark the highest year-over-year earnings growth rate reported by the index since Q1 of 2022. And you asked the question of how expensive things are right now. Well, on a story of valuation, the forward 12-month PE ratio for the S&P 500, 21.2. Why is that significant? It's above the 5-year average and above the 10-year average. And so ultimately, that's something that we're going to be tracking as we go throughout this earnings season as well. Another big story that we're watching, Boeing has agreed to plead guilty to a criminal fraud charge surrounding 2 fatal 737 MAX crashes from 2018 and 2019. The case was brought back into the spotlight after U.S. prosecutors said the plane maker failed to comply with a 2021 settlement agreement over those crashes, which left 346 killed. And here, as we're continuing to track the move pre-market, as of right now, it's up by about 1.2% right now.
Ian, as we take a look at that early reaction here with shares up just about 1%, we certainly can, I guess, try to figure out exactly what this means for Boeing here going forward. You talk about the fact that this was largely expected going off of the reports that we were getting last week. But now the question is exactly maybe what this means for some of those defense contracts going forward and whether or not that puts some of those contracts in jeopardy. And then also just some of the risks that this brings up here for Boeing when we focus about the fact that, hey, maybe this is obviously it's a hit to their reputation, but how big of a hit, what this means for investors, what they need to do to win back some of the confidence clearly is a big question mark at this point.
Absolutely. For more on this, let's bring in George Ferguson, Bloomberg Intelligence Senior Analyst, to discuss this just a little bit more. George, as you see this guilty plea come through from Boeing, what more largely does this signal for the company and the way ahead?
Yeah, so I think it's a good sign from the aspect that they're starting to clear some of these problems, some of these legal overhangs, and that's going to help them focus on the most important thing to do with the company, which is to build more airplanes, generate more cash flow, and generate profits, right? We're really looking for a strong rebound for the company in the back half of the year. They burned $4 billion in cash, in 1Q. The company told us to expect a similar level of burn in 2Q. We saw less airplanes delivered than we expected, so it could be even higher. They had hit sort of a sub $10 billion cash on the balance sheet level at the end of 1Q, came back to the capital markets to raise $10 billion in bonds. Again, I think they burned another $4 billion in cash. They could have about $13 billion of cash as they close the second quarter down. I think that's a low level of cash for the company. So again, they can't keep burning cash like this. They've really got to start to focus on building airplanes. And so this agreement with the Justice Department, as well as the purchase of Spirit Aerosystems, so they can improve quality throughout all their factories, is really part of the turnaround for the company. The next really big hurdle is they have negotiations with their most important union. I think they're already ongoing. Contract expires in September. That union wants a 40% increase and a guarantee of building the next airplane up in the Pacific Northwest. That's going to be the next big hurdle, but Boeing's got to start to put these behind it so it can build airplanes and generate cash.
George, do you think that this is a big blow to Boeing's reputation? You talk about some of those upcoming events that we need to focus on here as Boeing does look to move forward, but how tough is that going to be, at least in the short term?
Yes, I mean, I kind of feel like the reputation's been pretty sullied here. I think it's frankly probably better to get this done now. We all know they've had problems. We all saw the door plug saw the video of the door plug come out in the Alaska Airlines. I think if they could put this stuff to bed now, it puts them in better shape, like I said, back half of this year and into next year, not talking about it. But I think we all understand there were problems. And so I think the reputational damage from this is slight compared to all the other issues they've been having.
George, what's interesting, and our own Alexis Keenan pointed this out within her reporting up on Yahoo Finance Now, as she was speaking with a former federal prosecutor, there's revenue and profit implications here too, because of if they are indeed, found guilty as they've entered this guilty plea, ultimately this impacts their ability to do government contract work as well. So what are the potential ramifications that could spill over even to the valuation for Boeing?
Yeah, so my understanding was as long as the company wasn't considered a felon, I think, look, I'm not a legal expert. Somehow I think there could be a felony charge and conviction against the company. They could potentially have problems and not be allowed to take, government contracts. Now, I think, the way we look at this, there are products Boeing supplies to the U.S. military that I just don't see any near-term substitute for. One of them would be KC-46 tanker. It's a program that's been in the news. They've taken a lot of charges on the program. Airbus bid for and actually won it initially, but then after an appeal, Boeing took that contract over. It would be really hard, I think, to move that contract at this stage back to somebody like Airbus. And the tanker fleet for the U.S. military is 50 years old. It needs to be replaced. So I think there's a lot of need. We're watching backlogs in the defense industry build. So I think the government wants to find a way to make sure Boeing can be a government contractor, an important defense prime, despite whatever they're pleading guilty to here. So I think they'll find a way through this.
And George, when you take a look at this, Boeing's now going to have the oversight of a monitor. It's going to help, as we'll have to spend more on safety and compliance, maybe when building aircrafts moving forward. I'm curious just the cost of this. When we talk about the fact that clearly the cash burn rate had already spooked investors looking forward to this, maybe this is going to add even more costs, especially obviously when you factor in the fine. How big of a headwind is that going to be?
Yeah, so I don't have a good number on that because I don't know what this monitor costs. What I would say is, I don't think it's going to be a lot. I think what's going to be more important, again, is going to be this union contract that's coming up that I think could add 0.5% to 1% to some of the cost of manufacturing. I think that we could all probably agree it's not like Boeing couldn't use more oversight here, and it would be more costly for them to continue to have problems. And so I think, look, in the long run, we kind of know near term, next 2, 3, 4 years, you don't have a Boeing that has margins that will look like what we're in the pre-pandemic world, right? I think the book of business is in at a lower price point because Boeing lost a lot of China business and they had to go out and fill the backlog again. They did it at some good customers like Southwest and United, I think at lower prices. We know the costs will be higher with oversight, like this overseer, as well as they need to have internal controls that have more inspectors in place and more training. So we kind of know the company's not going to have margins that look like pre-pandemic. But look, again, I think they just need to stop burning cash. And that's the beginning of the improvement in this story. And I think you can only do that through more commercial builds. And they got to start getting that done as they get here into the second half of the year.
George Ferguson, always great to get your insight. Thanks so much for hopping on with us this morning.
Yeah.
Well, Senate and House Democrats returning to Washington today for the first time since President Biden's poor debate performance. And after top House Democrats privately met on Sunday to talk about how they can convince President Biden to drop out of the race. This is according to reports. In an exclusive interview with ABC News anchor George Stephanopoulos, President Biden doubled down about staying on the ballot.
I'm running again because I think I understand best what has to be done to take this nation to a completely new level. We're on our way.
To discuss the road ahead to the White House and what it means for the market, we want to bring in Ed Mills. He's Raymond James' managing director. Ed, it's good to see you. So President Biden went on, had this interview with ABC's George Stephanopoulos, and he did it to convince or try to help convince voters that he is suited, that he is the best person for Democrats to run on the ballot here in November. Was it enough? Did it change voters' minds, do you think?
Donna, this is really tricky because he did better in that ABC interview than he did at the debate, but certainly didn't do enough where it was going to quiet critics. I think that it was a massive shift in sentiment, especially among congressional Democrats in the June debate against former President Trump. And what I've been telling clients is that people with power like to keep power, and we're on a collision course because Biden clearly looks as if he wants to stay in this race, and he has the delegates, if he stays in, to capture that nomination. On the flip side, congressional Democrats are looking at this race and are concerned that Biden's going to lose. and are even more concerned that it could cost them the majority in the House of Representatives, which Democrats were looking to be on a decent track to capture, and certainly really has to downgrade the chance that Democrats are able to hold on to the majority in the Senate. So that conflict here, I think, is going to play out very publicly this week. We probably have to have a decision mid-month because there's an August 7th deadline for the ballot in Ohio that Democrats need to make. And that's really, to me, where we're looking at when a full final solution will be developed.
Ed, as we're sitting here looking through the president's kind of rebuttal to fellow Democrats that have pushed back and congressional Democrats that have pushed back on him continuing to run, I'm looking at this letter where he's talking about even this morning, this process that was open to anyone who wanted to run. He feels a deep obligation to the faith, the trust of the voters of the Democratic Party placing in him to run this year. But with the clear erosion that has started to show up of that confidence in President Biden, how does this party now figure out, okay, where it remains and regains strength, especially with the business community, trying to make sure that it has its big donors that will still put money towards a campaign that has started to shift in this interim period?
Brad, you're right. I do think that one of the things that I tell clients at Raymond James is that things are impossible right up into the moment it's inevitable. And those things will happen pretty quickly. So in the interview with ABC News, Biden was very clear that he has not heard from the leadership of the Democratic Party, that he needs to step aside. He highlighted his conversations with Hakeem Jeffries, with Chuck Schumer, with governors. But if that were to start to shift and you did see a freezing of money, that it could change the calculus here. There is a difference now as it relates to financing your campaign where there's so many small dollar donations. And as long as he's keeping that, he probably can stay in the race. As it relates to the market, what we've been getting questions about is how much of a Trump victory is getting priced in. Was that part of the steepening of the yield curve that we saw last week? When we look at the agenda of tariffs, of potential extension of the tax cuts, are there inflationary concerns that could impact the monetary policy decisions of the Federal Reserve? All of these are major questions that are hinging on the question of, is Biden going to stay in the race? And if he does, can he win the presidency?
Well, let's talk a little bit more about how this all plays out in the markets. I guess two questions here. One, is there between former President Trump and President Biden, is there consensus on who is better for the markets and why? And then my second question will be, as we talk about the fact that even though maybe it's not too likely, but this potential for President Biden to be replaced on the ballot of the names that are being floated, is there one that's better for the market than the others?
So, Shauna, I'd start with the first question you had. I think that there are a knee-jerk reaction that a Trump victory could be a boost to the market, especially in areas that are heavily regulated, that have seen slowdowns of M&A, or could benefit from the continuation of the tax cuts. So financials kind of front and foremost on that list. I think you would see a bid in bank stocks in a Trump victory. But the thing I do remind folks at Raymond James is that when we go back to the first term of President Trump, there were multiple times where the S&P 500 were down more than 20% over the China trade fight, and he's vowed to restart that. So I think there's more volatility, even though there could be that knee-jerk positive reaction in a Trump victory. I was meeting with clients in Europe 2 weeks ago, and they, I think, generally felt as if there was a continuation of the Biden presidency. A lot of the clean energy and infrastructure projects could get a continued boost. And the allocation to the United States, because of a known outcome of what was going to happen in D.C., would keep greater confidence. So it's a much more nuanced answer versus like one good versus one bad.
And then on the second part of Shauna's question there as well, if Biden was to be replaced, is there, of the list of candidates, someone who the markets would look as best outcome?
So it's hard because I think that the most likely candidate, in our opinion, would be Kamala Harris, the vice president, taking over the nomination. First and foremost, she's been the vice president. That's the role of the vice president if the president's not able to serve. She also would be able to inherit the campaign infrastructure and funding. So she's put at the top of the list. When we've debated at Raymond James some of the differences in policy between a Kamala Harris and and a Joe Biden, there's not a huge gap because Vice President Harris, when she was in the Senate, she certainly was kind of a leader on issues, but there's not a whole list of policy differences that you would have if there were to be at the top of the list a Bernie Sanders or an Elizabeth Warren or someone from the much more progressive wing of the party. So if it is Harris, I don't really think that there's a big change. I think she is more liberal on things, but her ability to get things done, because she doesn't have the same deal-making experience that Joe Biden has because he's been in D.C. for 50 years. The question is maybe a little bit more liberal, but maybe fewer things get accomplished. So from a market perspective, I don't think there's a huge change. The only change that could be kind of priced in is she might have some more downside to Biden as it relates to the election, but she also has a lot more potential upside. And so if we were talking about a Democratic sweep, we'd be looking at increases in tax rates, changes to the number of prescription drugs we negotiate on, maybe a more enforced M&A environment. So that's where we could see patches of weakness in this market, Brad.
Ed Mills, Raymond James, Managing Director. Ed, great to see you, and thanks as always
Likewise.
for joining us. Appreciate
Thank you, guys.
Certainly. French stocks rebounding after the country's left-wing party winning the most seats in the election's second round, but leaving no party with an absolute majority, leaving France with a hung parliament. To discuss, let's bring in Yahoo Finance's Akiko Fujita. Akiko, you've been all across this French election here. What do we know?
Yeah, it's been a busy election cycle, you could say. Well, that reality of a hung parliament you just highlighted is exactly why we're seeing a fairly muted reaction to these election results, at least in the markets. The CAC 40 index just slightly higher after initially falling in opening trade. This was a huge reversal from the first round of the elections. Remember, it was just 1 week ago when a strong showing from far-right party National Rally raised the potential of the party taking a majority in the National Assembly. On Sunday, it was a different story after the centrist and leftist parties coalesced around select candidates with voter turnout at its highest rate in more than 40 years. You see the numbers on the screen there. The leftist coalition, New Popular Front, taking 180 seats. The Ensemble Alliance, the centrist party, 159. And then the National Rally ending up with 143, at least according to results posted by the Financial Times. With no party capturing a majority, the hard work now begins with the potential for government gridlock in France just weeks before the country is set to host the Summer Olympic Games in Paris. The first order of business will be settling on a new prime minister. President Emmanuel Macron has asked current Prime Minister Gabriel Attal to stay on to ensure stability for now. But we should highlight there are critical divisions between these coalitions on policy, particularly when it comes to the country's finances and growing debt. Leaders under pressure to cut its deficit, now forecast to grow to 5.1% of GDP. But the leftist New Popular Front has called for spending increases, talking about increased benefits, higher public sector wages, more housing benefits. All of that is likely to total roughly $380 billion over the next 3 years. The coalition's also proposed rolling back one of Macron's signature policies, raising the country's legal age of retirement. Now, as for Le Pen's party, the National Rally's momentum may have collapsed in domestic elections, but it's still looking to gain influence in European Parliament by joining forces with a far-right political faction led by Hungarian Prime Minister Viktor Orban. His spokesperson posting this message on X, saying this new right-wing faction could become the third largest in the European Parliament.
All right, very important update there. Akiko Fujita, thanks so much for breaking everything surrounding the croissant trade down for us here this morning. Appreciate it. We're just getting started here on Morning Brief. Coming up, a done deal. Paramount has accepted Skydance Media's $8 billion takeover bid. We've got some of the top trending tickers next. Plus, Hurricane Beryl makes landfall along the Texas coast. We'll break down the Category 1 storm's impact on oil prices. And then later on, big banks setting the stage. Financials set to kick off the start of Q2 earnings reports this week. What this means for the markets later on in the show. You're watching Yahoo Finance Morning Brief. Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th. It's time for some trending tickers this morning. Shares of Paramount moving higher after Paramount Global reportedly agreed to merge with Skydance Media, marking a new chapter for one of Hollywood's oldest studios. Yahoo Finance senior reporter Alexandra Canal has the details. I mean, Alexandra, where were you when the entire deal and the talks even started? My goodness, it's been years.
Oh, I know. You really couldn't script this better if it was a movie, Brad. After months of back and forth talks, sweetened offers, a deal that was approved, then not approved by Executive Chairwoman Shari Redstone, we have finally reached the end of this media merger saga. Skydance receiving approval from Paramount's special committee on Sunday before Redstone gave her own stamp of approval after she initially rejected a deal on June 11th, but less than a month later, the two sides have made it official. Now, this will be a two-step transaction. So first, Skydance will pay $2.4 billion to acquire National Amusements. That's the holding company that controls Paramount through its Class A voting shares. Skydance will then fully merge with Paramount, with those Class A stockholders receiving $23 a share, while Class B stockholders will secure $15 a share. Now, this values Skydance at about $4.75 billion. In terms of the leadership team, Skydance CEO David Ellison will become chairman and CEO, while former NBC Universal executive Jeff Shell will serve as president. In a press release, Skydance said it will, quote, reposition Paramount to improve profitability, foster stability and independence for creators, and enable more investment in faster growing digital platforms. And like we said, I mean, this does represent a new chapter for Paramount, which also owns iconic brands like Nickelodeon, BET, MTV, Comedy Central, among others. There is a 45-day go shop period where other potential bidders could submit offers, but it does seem like Redstone is fully committed to go ahead with this new and improved Skydance transaction. It is still subject to regulatory approval, but it is expected to close in the first half of 2025. Shares are up slightly in pre-market trading, but did surge as much as 8% last week when rumors first started to swirl that the deal was back on. So a new chapter here for Paramount Global. This is the first time since the 1980s that we're under new ownership here. So a pivotal time for this company.
All right, Allie, thanks so much for breaking that down. Again, Paramount, a name to keep on our radars here today. Well, we've got the opening bell on Wall Street as we kick off a new trading week. Again, the major averages, not huge movement that we're seeing here right at the open, but coming off, Brad, another record-setting week here for the markets.
Yeah, we were taking a look at the two bell ringers there. You had Smurfit over at the NYSE, and then it looked like you had some athletes over at the Nasdaq. Team USA repping. I see one of my former colleagues, former boss, Bob McCooey, up there on the podium as well here with some funfetti. We're just days, weeks away now from the Summer Olympics that we're all going to be watching. Well, anyway, there you're taking a look at the opening bell. We open up higher across the board here.
All right, let's kick it over to Jared Blickery as a closer look at some of this movement that we're seeing right at the open. Jared.
Yes, a little bit of a rally here. So we got the Dow up about 108 points. That's only worth about 0.25%. So kind of a sleepy open here is to be expected. We've got the Nasdaq on, I think it's up 6 weeks in a row. Don't quote me on that, but definitely a nice string. And we talk about this time of year. The first 10 days of July are actually the most bullish period of the year. So great time to be long. And let's take a look here. Let's see, we got the VIX, that has been heading lower. We also have the dollar heading lower. We also have the 10-year Treasury note yield heading lower, and all of that is bullish here. Let me just show you the VIX really quick. This is a year-to-date chart. You can see it's inflected just the tiniest little bit right there at the hard right edge of the chart, but definitely near the lows of the year. You could draw that line all the way back. Here's the 10-year T-note yield. That's heading down as well, but approaching pretty big support. 4.2 to 4.25 is the area to watch. Not quite there just yet. And we were watching tech as the early leader today, but it is now in fourth place. XLK right there, kind of in the middle of your screen on the top row. Then we have industrials. That is a leader now, followed by financials, and then materials, real estate, I should add, also outperforming. Energy, communication services, consumer discretionary, all three of those are heading down right now, but again, not any big movements. And then I want to track Tesla. Tesla is down about 1.6%, and this is going to snap something like an 7 or 8 day win streak for Tesla. There you can see over the last 10 days, it is up 35% and is off to the races here as soon as it broke above $200 per share. But now it is reaching a potential resistance point. So we'll see if Tesla pauses.
We will. All right, Jared, thanks so much for breaking that down. We want to draw our attention to Eli Lilly and also shares of Morphic here this morning. Eli Lilly is right around the flat line after agreeing to buy biopharmaceutical company Morphic, a $3.2 billion deal. You're really seeing the action play out in shares of Morphic. They're up just around 75% right now at the open. Anjali Kamlani is here with the breakdown as to why this makes sense for Eli Lilly. Anj.
That's right, Shauna. We know that Eli Lilly, of course, flush with cash after the booming success of its GLP-1 drugs, that's Mounjaro and Zepbound, and it is putting that cash to use. The CEO has already indicated interest in early stage deals, and this just fits the bill for that. Morphic with its ulcerative colitis treatment in phase 2, that matches sort of what Eli Lilly already has. We know we just think of it as a GLP-1 company, but it does have more under its belt and in its pipeline. And this does match that pipeline for Eli Lilly. We know that they've already gotten one drug in the same category approved last year, and they're looking at this to sort of boost other areas as well, including cancer. So there are sort of reasons why this deal fits Lilly's portfolio. We do know that Morphic, of course, with being a smaller biotech, of course, that stock is up quite significantly. You're not seeing this push Lilly's quite as much, but it could help in the longer term. We know the market cap currently sits at about $870 billion. So could it inch up to that 900? I know everyone's watching that part of the stock, but this deal as is going through, Lilly said it should close by the third quarter of this year.
All right, Anj, thanks so much for breaking that down. Again, we're just 4 minutes into the trading day. Let's take a look at where things stand right now. You got all three major averages opening the trading week in the green. You've got the Dow up just over 200 points. That's a good for a 0.5% gain. You've got the S&P up another 0.2%. The Nasdaq also moving to the upside here. So we'll see whether or not those gains continue throughout the trading day. Keep it right here on Yahoo Finance. Much more on the morning brief when we come back.
We're tracking the major averages here this morning. They're off to a good start as we begin this new trading week ahead of key inflation data out this week, which might fuel or could even constrain the rally depending upon which way the reading comes in. To discuss further, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist here with us. I mean, Keith, I want to be optimistic. I want to feel like the data is going to come in favorable of some of these potential cuts that we've been talking about. Sure, maybe not July, but September, it'd be nice to see that more firmed up a little bit. I don't know. What are you keeping close tabs on here that could sway the Fed one way or the other?
Yeah, well, first, great to be with you, Brad and Sean. I hope you all had a great 4th of July extended weekend. So thinking ahead, the way we're thinking about the overall picture right now is the Fed is likely to cut rates in September. We see an economy that is cooling. We wouldn't call it weak, but it is cooling. And we're seeing those inflationary trends also cool somewhat. So we think it's going to be time for the Fed to start moving. And we expect 1 to 2 Fed cuts this year. And that actually continues. What we're starting to see is a slow but global easing cycle. You put that together with profits that are still moving forward. We still think that's a positive environment for stocks. But again, probably not at the same pace that we saw in the first half.
So then, Keith, what do you think the gains then would potentially, if the movement then is still to the upside, it seems like that trend is intact. What do you think then maybe the gains more realistically look like from here?
Yeah, I mean, I think realistically, somewhere in the 5 to 10% range, we could still see that. If we look at, instead of what I think, the historical data as a starting point, we've seen 27 times historically where the market has had a 10% plus first half. If you look at the second half, you tend to add to gains, or you've seen gains added 24 of those 27 times, so 89%. So that's a pretty good hit rate. The average gain has been about 9%. But here's one important stat, too. In that back half, the average peak to trough decline, meaning at some point you have a hiccup, is also around 9%. So we think the trend is higher, but we do think we'll see 1 or 2 pullbacks along the way. And again, the main support should be fundamentally earnings moving forward.
Keith, where does tech fit into all this? Because you had been bullish on tech for many months at this point. Recently, though, downgrading it to more of a neutral holding. I'm curious then what that tells us about maybe the concentration. Are we going to see broader participation, and how investors should be viewing tech at this point?
Yeah, it's a good point. We were overweight tech since last November, and then in late June, we actually downgraded it to a market rate. So again, not a bet against tech, but it's saying, hey, we just had one of its, we're up over 30% this year, over 40% since we upgraded it in November. We saw in last month, the relative performance in late June became the most on a 1-month basis in about 20 years. So our main message to our clients was like, listen, we still like tech. We don't think this is a bubble longer term, but on a short-term basis, we're getting a little bit overheated, a bit stretched, and we just think there will be a better opportunity to redeploy capital there in a more meaningful way. But what that means for the overall market, if the tech is such a big part of the overall market, we think as we get maybe towards the back half of July, maybe some more chop and some digestion, maybe some rotation within the market. What's interesting, Sean, is you're also seeing rotation within the Mag 7 itself, but I do think we'll see some of that rotation and maybe more of a choppier market as we head into late July into August.
Which sector is the biggest beneficiary of rotation at this juncture, Keith?
Yeah, it's a tough call because in our sector work right now, we only have 2 sector overweights, which is still communication services, which is still tech oriented. And then we have something, utilities, which is more defensive, maybe a little bit of an AI play, but also which should be supported by lower yields. I think it's more like what's going to happen is you're going to just see maybe not things standing up, but maybe a little bit of money going to financials, industrials, energy. It's just kind of a little bit of a rotation into other areas. And then I think later in the year, I think money will come back to tech, and we'll be looking at potentially upgrading it. But we're going to be patient for that opportunity to present itself.
Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, thanks so much again for joining us here.
Great to be with you.
Likewise. All your markets action ahead. Stay tuned. You're watching Morning Brief, everyone. Hurricane Beryl making landfall in Texas, bringing with it strong winds, power outages, and thousands of flight cancellations. The ports of Corpus Christi, Houston, Galveston, Freeport, and Texas City closed yesterday in preparation, putting some offshore oil and gas production at risk. Oil prices sliding this morning after rising for 4 weeks. Let's bring in Rob Thummel, who's the Tortoise portfolio manager here with us. Rob, as we were taking a look at WTI there, and thanks so much for joining us, by the way, as we're tracking the developments surrounding Beryl, what is the larger, more outsized impact that you're watching for right now, especially as it relates to commodities and oil?
Yeah, so for oil prices and commodities, so one of the things that the U.S. has become is the largest exporter of energy in the world, and so unfortunately, where Beryl is really going through is one of the key ports, and you mentioned all the ports that are closed. So hopefully, the destruction is limited just for the people and the human element of it. For the business element of it, there's a lot of infrastructure that's right around the Corpus Christi area. And that infrastructure will be temporarily closed. I don't know if there's ever good news in a hurricane, but the infrastructure has been built, I think, to withstand these hurricanes because they have been more common. But we'll see less exports of oil, diesel, natural gas, potentially gasoline, and so. For the U.S. consumer, that's probably going to be a good thing because you're going to see a lot more supply of these products still. But not as much demand from the export side. So prices actually probably will come down temporarily here as an impact, or as the primary impact of Beryl itself.
Rob, how much pressure do you think we could see on prices?
Yeah, that's a good question. Let's talk about oil prices in particular. Oil's around 82. There's probably a geopolitical risk premium of a couple dollars in oil right now. It wouldn't surprise me if you see oil prices come back to $80 a barrel. So not a tremendous amount, but a little bit.
And with that in mind, you mentioned something really key, is that more of the infrastructure is actually being built up to withstand weather events like this. For the industry and the operators, how much more investment, capital expenditures, do you expect them to put forward towards safeguarding against future events? Hurricanes, other severe weather events as well?
Yeah, that's a very good observation. What I would say is, the energy sector in general, one of the things investors like about the sector is the capital discipline, which has led to a significant amount of earnings that have been converted to cash, and then that cash is then being paid back to investors in the form of higher dividends and stock buybacks. I don't expect that we'll see a significant amount of new capital expenditures. Really, at this point in time, this capital discipline will remain in place. Now, a lot of these assets have been built in the last several years or in the last decade. So a lot of the capital has already been spent to really harden these assets and prepare them for events like what's going on right now, and obviously future hurricanes that will happen in the future. So I don't think there'll be a tremendous amount of new capital expenditures focused on hurricane preparedness or anything like that.
And Rob, outside of what we're seeing weather-wise in Hurricane Beryl here in the U.S., of course, when we talk about the price of crude and the price of Brent, a lot of that being factored by the possibility of rising geopolitical tensions. I'm curious how you're factoring that into not only your short-term projections, but really also what we could see for that price action looking ahead towards the end of the year.
Yeah, so Tortoise, we like to focus on the companies that don't have as much of commodity price exposure from an energy perspective. But but specific to your question, how we are looking for commodity prices going forward, we think the futures curve's got it right. I think on oil and even potentially natural gas. So, big picture, the OPEC production cuts are entirely in place through the end of September, and then OPEC Plus is going to gradually bring up production through the end of the year, just gradually, adding back a couple 100,000 barrels per day. If demand remains in place globally and meets what everybody's expecting, you're going to have an undersupplied crude oil market for this quarter and next quarter as well. That'll bring inventories down, and when inventories come down, that means prices go up. So it wouldn't be surprising for us to see oil prices range bound between $80 and $90 per barrel between now, really, and the end of the year.
All right, Rob Thummel, always great to get your insight here. Tortoise Portfolio Manager, thanks so much for joining us.
Thank you.
Coming up, France's latest parliamentary elections brings new challenges to President Macron. What it could mean for the European markets next. France's left-wing coalition stunned Europe as a new Popular Front won the biggest share of the National Assembly. But the election, though, failed to produce a majority, raising the risk of a hung parliament. Now, for more on what this could ultimately mean for the markets, we want to bring in Sebastian Radler. He's Bank of America's Global Research Head of European Equity Strategy. Sebastian, it's great to talk to you. So here we are today. We had the surprise movement here from the left, and I think many investors are trying to figure out exactly what this means or how this is going to play out in the markets. Given this political uncertainty, what could that signal then for the movement we could likely see in European equities?
Well, I think the easiest way to summarize it is that you really have French politics offering itself in a very complicated and complex mix of macro drivers as a potential driver for the market. And with the result that we got yesterday, it simply means it won't be a driver. This will be a domestic phenomenon. You likely get gridlock. You have to now find a coalition, potentially get a caretaker government, potentially a technocratic government. But the idea that you could get meaningful swings and risk premium because of what's happening in France is off the agenda, because the downside risk scenario of a hard right government basically going in confrontation to the EU and potentially raising the political uncertainty from there, making an impact at the pan-European level, that is off the table. And therefore, it's effectively, it offered itself as a catalyst and likely now will not be.
I mean, the elections have done a number on the CAC 40 as we've been tracking that over the past several weeks here. It's been down by about 7% since about mid-May. So all these things considered, now that the dust is finally settling here and we could see some gridlock, is that net positive for what we're tracking in the CAC and more broadly here within stocks that are traded internationally, or at least most French touching, if you will?
Yeah, it depends a little bit from what your starting point is. Relative to where you were, let's say, a month ago, it's a negative because you basically have replaced a pro-business, pro-reform government that was, given the lethargy that you have in German politics at the moment, it was a clear leader at the European level. And you now have basically a government that is incapacitated and has to find its feet, and that will likely take weeks, if not months. And even then, you might have an ineffective government compared to what you had in place before. So given where you a month ago, this is a negative development, but given what could have been, i.e. this kind of political confrontation with the hard right, so it's a relief relative to where you were a week ago, but still a deterioration over the past month or so. But overall, it means that it will not be a main swing factor for European equities. You've got other things in play. For instance, what happens to the US macro cycle? What happens to the European macro cycle? What happens to US politics? And on a relative basis, these factors will now be far more important than this little French drama that we've lived through over the last 3 weeks.
Well, Sebastian, given all that, I guess, what is your base case projections then for European equities? When we talk about some of this uncertainty or maybe this downward pressure that we could see, what does that then downside risk look like?
Yeah, so we're at the very bottom end of the consensus range. We've got around 15% downside in an environment where generally everybody is bullish. And everybody's bullish because the global economy, helped by the US, has been tremendously strong over the last 2 years after a recession scare that we had in 2022. So if you look across markets, you've got markets at an all-time high. You've got risk premium at a multi-decade low. So the global equity risk premium at 3.4% is the lowest level since 2002. And you've got earnings and margins at all-time highs. And that is because you're very late cycle in the US. You've got basically, you have had all the recovery in the labor market, all the recovery in consumer spending, and we're now starting to see first cracks. So the big story in the US over the past 2 months is that you've seen a clear-cut weakening of growth momentum, and everybody's now holding their breath and saying, is this just a normalization from the overheating that we've seen over the past 18 months, or is it the signs of a turn in the business cycle from late cycle to end of cycle, and then you would get rising unemployment, you would get rising risk premium, declining earnings. Everybody's holding their breath, and we think that's a likely development because all the typical lead indicators, monetary policy working with a lag, the fiscal support that you had last year starting to fade, all of this points to more macro weakness to come. And we think that will feed through. It will mean higher risk premium and lower asset prices. So we are very defensively positioned, and we see downside for equities as this macro weakness comes over from the US.
Sebastian, we only have about 45 seconds, but what do the results of this election hold for U.S. tech companies who have gotten hit with more fines as we've seen the European Union and its members be a little bit far more stringent about punitive damages and even compensatory damages for U.S. tech companies and how they operate in that region?
Yeah, I think, to be honest, given everything else that's going on in US tech, I think it will be a secondary driver. But if anything, you have a less business-friendly administration very likely in place once the dust has settled. So potentially more focus on trying to extract taxes from these tech winners that you have in the US.
All right, Sebastian Radler of Bank of America, thanks so much for joining us here this morning. We've got much more of your market action ahead. Again, you're looking at gains across the board. You've got the Dow still up just over 200 points. You've got the S&P up about 0.2% as well as the Nasdaq. We'll be right back. just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
The Fed is in focus this week as Fed Chair Jay Powell is set to give his semi-annual testimony before Congress on Tuesday and Wednesday. That's going to be followed by key inflation data out Thursday. Investors will be watching all of that for any clues about the Fed's path forward.
And Boeing pleading guilty to criminal fraud charges in connection with 2 fatal crashes of its 737 MAX jet. We'll discuss what comes next for the troubled plane maker.
And another critical week for President Biden as he prepares to host NATO members ahead of a planned press conference on Thursday. With Congress back in session, Democrats are reportedly discussing the status of his campaign for president. We're going to discuss what's next in the race. But first, we got to talk about markets. The S&P 500 up over 16% so far this year and closing Friday at its 34th record high of the year. That run is many firms boosting their year-end targets for the S&P 500. But one bank has decided to drop coverage of the index altogether, actually dropping their coverage of their year-end target for the index. Behind that call, we have Michael Kantrowitz. He's Piper Sandler's co-chief investment strategist. Michael, thanks so much for being here. I want to pull up a quote from your note on this. You say talking about the S&P 500 to communicate investment insights to investors has become an exercise in futility. I was giggling when this note came out because you definitely sound a little bit peeved by the AI rally. Is that what drove this call?
No, not at all. And it's not a change to my views. You know, we've been bullish all year, and I'm still constructive on larger cap equities. It's more about, you know, in the last few months, as I was trying to think about raising my target again, I didn't really feel that comfortable being intellectually honest, saying that I can have a high conviction view of where the S&P is going to end up. Nor did I think it really adds value to our clients who are institutional investors, who it's not about whether the market's going up or down, but really what you have to own and what you have to avoid. And we've seen correlations of stocks within the S&P 500 drop to about a 25-year low compared to the 500. So there's diminishing value in talking about the market because, again, most stocks are not trading like the market.
And Michael, given that, I guess for investors out there trying to figure out what happens next, you are still constructive on U.S. equities. You do still see opportunity. So if it's not within, or you don't think maybe it's helpful for investors to have a bull versus bear call right now on the S&P 500, what should investors be looking for? What are some of the more helpful views that you think at this point that tells a better story about where that opportunity is?
Sure. Yeah. And again, it's not, I think you have to have a bullish and bearish view, and we are bullish. But, you know, again, if I covered Apple or Microsoft and I was bullish on Apple or Microsoft and said, you know, the conclusion's clear, go buy Apple or Microsoft. If you're bullish on the S&P 500 this year, for an institutional investor that's not buying the index, well, how does that really help them? Because you look at the market this year, we're up 16, 17%. Typically, that much of a rally would come along with massive risk on leadership, small caps outperforming, and small caps, as we sit here year to date, have returned zero. And so we've been focused on where to invest. And for the last 2 years, we've been big bulls on larger quality, profitable names that essentially have economies of scale that can sustain their businesses the best amidst this higher interest rate environment. And so it's still very much a large cap growth call, avoiding smaller companies with weaker fundamentals.
Yeah, I heard you mention quality, and I want to jump in on that because you say that you continue to emphasize quality at a reasonable price. Where does that exist? Because isn't part of the problem the fact that quality valuations have really been bid up since the bottom in late 2022?
Yeah, well, much of the increase in valuations from late 2022 was just a recapture of the valuations that were lost during that bear market. So really, that was much of 23 was just kind of a give back on the 2022 bear market. From here, we haven't seen as much of a rapid improvement in valuations this year at the index level. Again, certain stocks have seen PE expansion. So we're looking for companies that have continued to outpace their peers in terms of earnings growth, that are of the highest level of profitability, And we're looking for those two types of attributes along with companies that have valuations that are not the most expensive. So you kind of have to sacrifice a little bit of growth, perhaps, in quality to find names that aren't egregiously expensive. But it's that sweet spot, which we call quality at a reasonable price. And we've got in the S&P 500, 50 names that have beaten the index this year. And it's not just about all AI or all tech.
Well, Michael, given the high bar that has been set this earnings season, are you cautious on the upside, just given the fact that the reaction that we could see for these reports that even do exceed Wall Street expectations?
Yeah, I think, the big question for investors has been, when will breadth improve in the equity market? And I think we've already had two surges in breadth already. One in beginning at the end of 2022 as inflation started to come down. The second surge in breadth at the beginning or the end of last year as the Fed pivoted. And from here, to get wildly bullish on equities here, you have to think breadth's going to continue to improve. And the likeliest catalyst that's going to come from is earnings. We don't think that's going to happen, though. Instead, we're actually seeing breadth for earnings, the earnings backdrop deteriorate. So if I was very bullish at the beginning of this year, because I still thought there was a lot more upside from lower interest rates and the Fed eventually cutting, I think we've priced that in so far. So I don't think PEs are going any higher from here. And it's really going to be about companies' earnings. And so I think, and that's why we're starting to see not only relative outperformance of large cap growth stocks, but absolute outperformance. The equal weighted S&P 500 has been down the last 5 or 6 weeks while large cap growth has continued to go up. So we're not wildly bullish because we're kind of moving along this evolution of a slowdown, and it's going to become, I think, even more narrow as we go forward.
Michael, I want to end on the macro with you because I know you expect unemployment to continue to drive higher. You call it softy locks. When does that start to become a significant problem for this economy?
Yeah, well, that's the top question we get from clients. So what we do is what we did last week is we threw it back at clients and said, well, at what level of the unemployment rate are you going to get nervous? Because when you can look throughout history, and there is no magic number where payrolls or the unemployment rate or initial claims hit and the market just all of a sudden turns over. Each cycle is a little different. With this cycle, there's still a pretty big focus on inflation coming down and the Fed cutting rates. And we think the unemployment rate will continue to move higher, but at the same slow pace it's been moving higher, give or take about 10 basis points a month. And so we think that level's closer to 4.5% at the low end. And the average client, or the most popular answer from clients, was 5%. I don't know if we can see another 90 basis point increase in the unemployment rate without a broad sell-off, but I don't think that's an issue right now as we sit here today.
All right, Michael Kantrowitz, always great talking to you. Thanks so much for making the time to join us here this morning. Piper Sandler's co-chief of investment strategists. Thanks so much, Michael. Well, President Biden responding to pressure to drop out of the presidential race with a letter to congressional Democrats this morning. This comes after a handful of Democrats have called on the president to step aside as the presumptive Democratic nominee. For more on the state of the race, we want to bring in Greg Valliere. He's AGF Investments' chief U.S. policy strategist. Greg, it's great to see you. So it's been, about a week and a half since we last spoke. And when I last talked to you, we were discussing about whether or not, or the likelihood that maybe we could see the Democratic Party nominate another candidate if President Biden were to step aside. But here we stand this morning, and at least taking a look at that letter from President Biden to congressional Democrats, it doesn't look like he has any plans to do so. Should he, though?
I think it's going to be a process that will last a while longer. I don't think we're at any kind of resolution yet. He's got a big press conference on Thursday, as you know. He's got the G10 meeting here in Washington for the next 3 days. So I think people will watch him very, very carefully without making any decision. This could drag on until the Democrats' convention in Chicago in mid-August.
Greg, would that be the final moment in this question of whether or not he is officially going to be on that ballot in November, or could we continue to see questions about it even after that?
It could be the latter. I got to tell you, I think if Biden makes another gaffe or says something that upsets people, at some point he's going to have to go. So I'm not positive that he is going to make it. I think in the last 48 hours, maybe the pendulum has shifted a little bit toward him, but we're still a long way to go. And I got to tell you, the big concern among Democrats on Capitol Hill is quite clear. They think they could lose the House, the Senate, the White House, and lots of governorships. That would be a bloodbath for the Democrats, and that's a plausible scenario if he is still on the ticket.
Greg, give me a number here quickly. What percentage chance would you put on Biden not being on the ticket come November?
I'm going to stick to my guns. It's one of the most difficult calls in my career, but I think the chances are better than 50-50 that he will not be on the ticket, that Kamala Harris at some point in the fall will wind up on the ticket.
Is she the best option for the Democrats at this point?
Oh, yeah, they have to take her. I think it would infuriate African-American Democrats, female Democrats. So she would be the replacement. I think a lot of people have gotten a little bit more excited by her. But again, I would reiterate, this is not over yet. And Biden's not out of the woods, but it could be weeks and weeks before we get a clarity on who is the nominee.
Well, Greg, I think the question here is, what do you think is going to get President Biden to step aside in this race? And is it one particular lawmaker? Is it someone that comes out and says that publicly that he should step aside that is going to make him change his mind?
Good question. I think, maybe a Chuck Schumer and Nancy Pelosi come out together and say he has to step down. That would have clout. Maybe if Biden's polls really took a slide. His polls are off a little, but they're not horrible compared to a month or so ago. Maybe he has another episode where he freezes up and doesn't appear to know what the answer is. So there are lots of things that could happen that could change this. But I'd say the polls in particular, especially the polls for the Senate and the House, because you've got a lot of really nervous senators and House members.
Yeah, well, you had President Biden sending a letter to congressional Democrats this morning saying that he does still believe he is the best candidate to beat President Trump. And the first policy he cites in that letter is his economic policy, talking about adding jobs, his economic vision. Who do you think is better for this economy, Trump or Biden?
Biden. I think his proposals have worked pretty well. I think a lot of what Trump is going to be doing would add to inflation. Trump wants a big fat tax cut. I'm not sure we need a big fat tax cut. Both of them want tariffs, which I think is a dumb idea. But I think when you look at the two of them together, I'd say that Biden has had a pretty good run. He's done fairly well on the economy, and I think that he would lead Trump eventually on that subject.
And Greg, let's talk a little bit more about those tax cuts, because I think initially investors are looking at that saying, hey, that this could actually be a good thing here for the markets, especially when you take into account maybe what the Republicans want to do when it comes to the corporate tax rate. And there has been talk, there has been push within that party to lower the corporate tax rate all the way down to 15%. Why should this bring some pause for investors there when you talk about it adding to the deficit right now, higher debt? Why is that so problematic in your view?
I'd cite two reasons. Number one, I'm not sure the economy needs a tax cut right now. We did 4 years ago, and we got one that had been too big. But the big thing that I think the markets are going to have to start worrying about is paying for it. I mean, an extension of the Trump tax cuts that passed in 2017, if we extend them for another decade, we're talking $4 or $5 trillion. I'm not sure we have the money for another big tax cut.
What does that mean for Wall Street then? Which of these potential candidates is better for investors, institutional investors?
Yeah, good question. I think as long as Jerome Powell sticks around, the Wall Street will be happy. Unfortunately, Powell and Trump do not get along, as you know. And I think if there's real friction between the two and Powell leaves, his term doesn't expire till the end of 2026. But I think friction between Powell and Trump would not be well received by the markets.
Greg, I'm curious from your view, because we've heard, and there's been lots of coverage on this over the last week and a half, about donors now starting to pressure and starting to speak about President Biden stepping aside. How closely does President Biden and the administration look at this? How much weight do they actually have in what is ultimately going to happen?
Yeah, I think that, well, both of them have a ton of money. No, they're not going to be scrounging around for loose change. They've got plenty of money. But I think that if one of the candidates, probably Biden, tends to see a decrease of fundraising, that's not a good sign. I think that's a sign that he is losing confidence with the financial community, with Silicon Valley. There are a lot of sources of money that could dry up, and that would not look good for Biden.
All right, Greg Valliere, AGF Investments, Chief U.S. Policy Strategist. Thanks so much for making the time to join us here. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Catalysts.
Shares of TSMC jumping over 3%, the company hitting $1 trillion in market value after Morgan Stanley and several other brokers boosting price targets on this chip maker prior to their earnings report. Optimism does continue to rise over the company's AI chips heading into those second quarter results, extending its rally more than 70% so far this year. And this is clearly a bullish signal, of course, for the NVIDIAs of the world as well. TSMC is the sole supplier of Apple and NVIDIA's most important chips. So that is making, this bullish signal not just apply to TSMC, but also those other names. It could be an indicator of those other names. Now, we had Morgan Stanley raising its price target on this stock by about 9%. So that is a significant raise there. They expect the chip maker to raise full year sales estimates in their earnings announcements coming out here in the coming weeks. The broker also seen TSMC hiking their wafer prices. That is a key portion of chips due to strong bargaining power and really the fact that TSMC is the only one at their level in this market right now, putting them in a position to have that strong pricing power, similar to what we see with NVIDIA. But again, TSMC, the only supplier for some of those big names like an Apple, like an NVIDIA, really positioning them well here.
Exactly. When you take a look at this, a lot of that driven by the pricing power that you were just talking about. And again, this move to the upside this morning really adding to this massive momentum that we've seen in TSMC shares really since the start of the year and going back even earlier. But since January 1st, this massive run up in the stock, you're looking at gains here over the last 7 months or so of just around 80%, I believe. There it is on the screen, 82%. When you take a look at some of their outlook here, TSMC may raise its 2024 full year revenue growth guidance to the mid 20% level. That was versus the previous guidance of the low to mid 20% level, citing that insatiable demand that we see for AI. And when you talk about that growth going forward, it doesn't look like anything is going to slow it down. So that coupled with the pricing power and projections here that they actually might be able to raise prices by as much as 5% versus that previous assumption of a 2% growth there, really showing that there might still be some runway on the stock ahead, but we will see if Wall Street is right at this point. All right, another call out this morning. We want to bring your attention to Meta. Wells Fargo raising its price target on Meta to $625 a share. That's up from $593, and taking a look as to why they are a bit more bullish on this name. They said that their checks suggest robust ads performance in the second quarter. Analysts there telling investors in that most recent research note, they also expect Q3 revenue guidance of $38 to $40.5 billion. That implies 6 points here of constant Forex, a deceleration at the midpoint. So again, some upward movement within Meta. They're saying that that's going to support their view as they see it in terms of where they are in that CapEx cycle and some of those potential gains here. But again, they're saying that they have solid momentum, keeping that overweight rating and raising their price target to $625 a share.
Yeah, and interesting that they talk about it being a CapEx cycle, not an OpEx cycle, which is interesting. This is also not the only call that we are getting on Meta here. We should mention that we also have this call from Wedbush happening a little bit earlier prior to the Wells Fargo call that you were talking about, Shauna. But Wedbush raising their price target on Meta. This is Scott Devitt from 480 to 570, that implying an over 5.5% increase from their latest price. So it should be interesting to see, particularly given that Meta in the last earnings cycle, that it was really their first print where they had kind of backed off from a defensive only strategy on their balance sheet, being a little bit more offensive, using some of that free cash flow on their balance sheet to invest back in the company's growth. Whether or not the street continues to reward them, even though they are shifting that strategy to using that cash on hand instead of just continuing to be defensive moving forward, Shauna.
All right, let's take a look at shares of SolarEdge getting a boost on an upgrade to neutral from underperform at Bank of America. B of A citing a more appealing valuation for investors since the stock is already pricing in, quote, worst case scenario when it comes to inventory write-downs and monetization issues. You're looking at a gain of just about 9%, back above $27 a share. They raised their price target to, or at least looks like their new price target on the stock is $29 a share. So again, seeing some upside there, given the fact that the worst case scenario, including those inventory write-downs, already been priced into the stock. They expect to see some modest recovery and a return to profitability in 2025. Actually, their price target was lowered to $29 from $44 a share.
Yeah, it's interesting because the words to watch here are both valuation and inventory, right? So obviously the valuation for the stock being something key to watch here, and that's certainly coming up with Bank of America. But they do talk about a worst case scenario, including inventory write-downs and liquidity constraints. We also heard this from Citi, saying that for the stock to work in the near term, management has to reduce that inventory. So that being a clear challenge, and that the company's long-term and sustainable profitability also continues to be a question. Citi rating this stock neutral in response to those question marks about sustained profitability, debt issuance for the company, and of course, the concerns around inventory being a little bit just too robust, and concerns about managing that inventory moving forward. We know that this is a stock that pops up on our trending tickers from time to time here on Yahoo Finance because it is that kind of solar name that is an interesting play in an interest rate hiking cycle, but interesting to see this commentary coming out, Shauna. Well, coming up, it is all about earnings season here. We're going to discuss what analysts need to hear from the big banks, kicking off second quarter results on Friday. That's next on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
It's already time for another cycle of earnings here, as we've got the unofficial kickoff for second quarter earnings starting up on Friday with the big banks. You've got JP Morgan, Wells Fargo, and Citi all expected to report then. But first, we've got some consumer names coming out here on Thursday. You've got Delta, ConAgra, and PepsiCo all set to report here. Now, expectations for second quarter earnings are very high. Consensus forecast for the S&P 500 do see earnings growing by 8.8% compared compared with a year ago. Now, that would be the highest growth rate since the first quarter of 2022, according to FactSet. So what are analysts expecting to hear specifically from the big banks on Friday to kick off this earnings cycle? Here we've got Max Guys, a portfolio manager at Gabelli Funds, to discuss. Mac, great to speak with you here. Earnings expectations have grown across the board, but of course that also applies to the big banks. How confident are you that they're going to be able to deliver on Friday?
Right. Well, I think the setup is pretty good for the reporting season, starting, as you mentioned, on Friday, a couple of weeks of banks. If you look at the asset levels in the markets, the S&P is up about 5% for the quarter. So that's going to lift, asset and wealth management earnings, especially at the big money centers. And then you also have a slight decline in the 10-year, which will help the marks on the MBS securities. So, you'll have a little bit of a positive for tangible book rising, plus the operating capital contribution and to net worth, et cetera. So we see continued steady progress here. Also intra-quarter, we had a couple of the banks already highlight investment banking will be pretty strong. JP Morgan said fees will be up 30% year over year. So that's a pretty good outlook. And, that translates into the other firms such as Goldman and Morgan, et cetera. So we're pretty positive. The banks have had a good run here. Some of them are up over 20% this year. But fundamentally, we think they're chugging along and in good shape.
When it comes to the expectation for deposit loan growth metrics, you expect that to remain muted here in the second quarter. It's going to be all about the guidance. What's it going to take to see some improvement here in the second half of the year?
Right. Well, I think there was, some dynamics with taxes, et cetera. It was more elevated this year. Then we have the movement, kind of the money market funds and out of the market, et cetera. So lots going on there in terms of those dynamics. But I think, we know that the overall industry, we see muted dynamics across the different platforms. But it would be nice to see kind of a gradual increase there and growth going forward. And so you get that leverage for NII in terms of a bigger balance sheet. So that's one of the things we're going to be looking for, a little guidance there, movement, and certainly the big banks have been beneficiaries of flows so far.
One thing I'm interested in is the read-through that we get on the consumer from these big bank earnings. And it was interesting, last earnings cycle, we had a lot of the banks indicating that they are giving us a read-through of consumers in a certain income group, particularly higher income, with a bank like Bank of America really only lending to folks with excellent credit, for example, here. Are the big banks still a signal of consumer health at this point, or is it a specific type of consumer?
Right, so there's a couple of dynamics there. I know there's been pressure on the kind of the lower end, and that is inflation and job growth, et cetera. But we continue to see pretty strong metrics out of the higher end. If you just look at American Express in terms of their consumer, which is mass affluent, that continues to do well, travel, et cetera. You can see that. Some of the retailing names that we've followed tangentially, have been impacted by the changing consumer patterns. But I think overall, deposit levels and consumer activity, look at charge, use of credit card balances, et cetera, still pretty healthy, slowing, but still pretty good for the big banks.
Mac, when it comes to who is best positioned, so within your financial services opportunities ETF, it looks like you own Bank of America, JP Morgan, Morgan Stanley, Wells Fargo, State Street, to just name a few. Where do you see the most value today?
One stock we like is Wells Fargo. So kind of a unique situation. They had some trouble a few years ago. Charlie Sharp's been turning around, simplifying the business. And here you have a bank on its way to a 15% ROE, trading at a forward tangible book of about 1.4 times. And then you have this ultimate catalyst in the asset cap being lifted. So they've made some progress towards that with some of the other consent orders over the last couple of years. And again, it's a pretty simple platform. They're making progress in banking, card, in terms of growth areas. And we see still very good value here in Wells.
It's interesting to me that Citi is not included in that ETF. Why is that?
So my colleague actually really likes Citigroup. I tend to favor the companies that have a little higher ROEs. And so, Citi is sub 10 ROEs. So, I tend to favor the companies that really generate capital, like JP Morgan, Wells Fargo as it improves, some of those institutions. So I think it's not so much not liking Citi, it's just we're finding more value in Wells Fargo at this point.
There's one of the issues or challenges or concerns, I guess, have been, however you want to phrase it, raised amongst investors over the last several quarters have been the exposure among banks to CRE, to commercial real estate. And a lot of that focus has been placed on the smaller, maybe more regional plays within the sector. But I'm curious from a big bank perspective, is that something that you're worried about? And I guess the levers that they have pulled, the positioning that they have altered as a result of some of the trouble that we are seeing within CRE, are they in a much better position than maybe we were a couple of quarters ago?
Well, I think they've managed their risk to that component of the market much better than, the smaller regionals, et cetera. They have a lot more exposure to CRE, and we've seen the stress there. And it's, this great refinancing wave that's going to go through America will affect a lot of these properties, and we'll see how that works out. But obviously, the smaller banks have underperformed the bigger ones, and that's partially a reflection of that better credit book and with respect to CRE. I think when you're a bank like Wells or JP Morgan, you're writing pretty significant loan sizes, and so there's a lot more due diligence, et cetera, that goes into some of this stuff, and they're very sophisticated platforms. So I think in terms of managing the overall book, they've done a good job. They're very well capitalized. They're on top of their credits. And so I think just the exposure being sub 10% for a lot of these companies, and also being in specific areas of CRE, they're doing better. I think they're well positioned to do that. And you've seen that in the results this year.
What is the single biggest thing that I can be looking at in these earnings reports on Friday to indicate how consumers are holding up?
Well, I think just there's a host of great leaders. Moynihan, Jamie Dimon, Charlie Sharp, all these are, they're great insight, great wide access to economics across their platforms. And so you just look for that management commentary and you get it. And then, Bank of America is a wonderful deck. They list a host of different components to their balance sheet and their customers, et cetera. So there's lots of good stuff that comes out of these calls that you can kind of really sum up to get an understanding of the economy. And they also give some forecasts and foresight too as well in what they're seeing, intra-quarter and what they expect to have happen.
All right, Max Sykes, portfolio manager with Gabelli & Funds. Thanks so much for joining us.
Thank you for having me.
Well, coming up, we're going to dive deeper into commercial real estate. We'll discuss why empty offices, vacant properties are a big concern for Wall Street. That's next.
From its start as a college social network to its focus on virtual reality, Meta has become one of the biggest tech companies in the world. In 2023, it generated over $134 billion in revenue and has nearly 4 billion active users across its various properties. Let's take a closer look at Meta's biggest moments with Beyond the Ticker. Meta began as Facebook, founded by CEO Mark Zuckerberg, Dustin Moskovitz, Chris Hughes, and Edward Saverin in 2004. Originally a college students-only social network, Facebook expanded its membership to the general public in 2006. In April 2012, Facebook acquired the photo and video sharing social network service Instagram for $1 billion. A month after that, Facebook went public via IPO at $38 per share. The company was valued at $104 billion at the time, the largest valuation to date for a newly listed public company. In 2014, Facebook acquired the instant messaging and voice over IP service WhatsApp for $19 billion. That same year, it acquired Oculus, a leading virtual reality company, for $2 billion. In 2021, Mark Zuckerberg fully rebranded Facebook as Meta, saying that while it would still remain a social networking firm, the new name would also emphasize the company's new focus on the metaverse. In 2023, the Instagram team launched Threads, a new text-sharing app designed to rival Elon Musk's X platform. Later that year, the company released the Meta Quest 3, the first mass-market mixed reality headset, as well as its Meta AI, a generative AI-powered digital assistant. In February 2024, Meta announced its first quarterly dividend, sending shares of the tech giant soaring. Meta reached a new all-time high stock price of $527.34 on April 5, 2024, and surpassed the coveted $1 trillion market cap. The company is now leaning deeper into AI while continuing to push into the metaverse. The company's ultimate goal is to blend the two concepts into one coherent platform that can propel its growth well into the future.
Some of the biggest names in the tech world, from Meta to Apple, continue to face scrutiny from European regulators. So will this wave of regulation abroad lead to more domestic legislation on this? To give us his take, we've got Tom Wheeler here, former FCC chairman and author of the book Techlash, Who Makes the Rules in the Digital Gilded Age. Tom, it's great to speak with you. Thank you so much for being here with us. Obviously, AI makes the regulation of tech question even more prescient. I'm curious from your perspective, if you can just give us some context about what is at stake here. What is your base case for the consequences if no real AI legislation and regulation comes to fruition here in the U.S.?
Well, first of all, thank you very much for inviting me to be with you today. You know, I think when we look at AI, we've got to recognize that all of the things that have happened in the last 12 months that have our heads spinning are probably the least amount of change that we will see in our lifetimes. And so the question becomes, how do we deal with that? How do we transform from an industrial economy that was overseen by industrial era style regulation to a digital economy, to an AI economy that has oversight to protect the public interest? And the challenge thus far is that, at least in the United States, our policymakers have failed to step up to that challenge. And we are seeing the rules being developed by other nations and by states in the United States, both of which will create new problems for those tech companies who rely on a uniform market.
Mr. Ray, what more specifically do those problems, do those issues look like? And you talk about the fact that some others outside of the U.S. have been taking the steps. Is what Europe is doing, are they saying a good example? Should the U.S. be following in Europe's footsteps when it comes to this?
Yeah, I think Europe is inventing a new paradigm, if you will, where they have said, first of all, we're going to step up and do something to ensure competitiveness and fairness in the market, something that American regulators have failed to do. And they've said, and we're going to do it in a new manner. We're not going to clone the old industrial era style regulation, which was micromanagement. Instead, we're going to say, here are the goals. Here are the four corners of what we expect for companies' behavior. And the companies, knowing that, are going to be expected to show us how they are complying.
Mm-hmm.
And that is a whole new approach. It is a much more agile approach. It is an approach that continues to encourage innovation and investment. And it is setting the standard for how we should approach things in the United States if we will ever get to that point with a Congress that has a hard time making any decisions.
Well, another key part of that, of course, is who is in the executive branch. From your perspective, who is better suited to oversee tech regulation from the White House, Biden or Trump?
Oh, I think it's pretty clear that Joe Biden has a thoughtful set of policies, whereas when we watched the Trump administration for 4 years, they were bouncing from this policy to that policy, depending upon apparently what the president was feeling that day.
How confident are you? It doesn't sound like you're too confident, but if we do see some sort of gridlock in Washington following these results, what does that then tell us about the likelihood that we will actually make any progress on these types of regulations against big tech? And I'm curious from your perspective, what needs to be done, or what would your advice be for lawmakers here, given the fact that this has been an issue that has been brought up on both sides of the aisle, yet either side can't seem to agree with each other on exactly how to address these issues?
Well, first, you said against big tech, and I am not proposing we do things against big tech. What I'm suggesting is that we need to have a countervailing force. That, for the last 25 years, you had a wonderful lead into this segment about the history of Meta. For the last 25 years, we have said, okay, innovators, you make the rules. And we, the public, we're just taking those. I mean, who decided that we would have no rules about protecting privacy? Who decided what the structural kinds of issues could be? Who decided that we will see the kind of aberrations in truth and trust that we have seen? What we need are a set of counterbalancing expectations. Not the micromanagement that we saw in the industrial era, but expectations that set the behavioral standards for these incredibly important companies. And I think it requires a whole new way of thinking about this. You were kind enough to mention my book, Techlash. That's what the conclusion of that book is, that we need to take an entirely new look at how we structure our oversight, that we have to have oversight of this incredibly powerful, important, and contributory new set of technologies. And that, like the technologies, innovators themselves, we must become equally innovative in how we create guardrails to protect consumers, to protect competition.
And it is a good point what you raised, the issue with my question, just saying against big tech. And I think that goes to this reframing of the conversation, right? So I'm curious from your perspective, what do you think the involvement should look like from those within the industry when we're talking about how best to regulate the tech industry?
Yeah. I think the key is participation rather than standing in front and saying no. That the first rule in Washington is it's always easier to kill something than to pass something. And I would hope that what we could begin to see is the tech leadership sit down and say, we need new rules. Let's work together to draft them. Brad Smith, the president of Microsoft, and Mark Zuckerberg, who you just did a piece on, have both endorsed the idea that we need a new digital platform agency with new approaches to regulation. Let's move beyond that. Let's sit down and start talking legislation. Senators Bennett and Welch have introduced a proposal like that in the Senate. Let's get specific and start talking about really how do we create these guardrails in this new era.
Tom Wheeler, unfortunately, we have to leave it there. Former chairman of the FCC, thanks so much for taking the time to join us, and congratulations on your new book.
Thanks.
Keep right here on Yahoo Finance. Coming up, we're taking a deep dive into commercial real estate. Whether or not the worst is over for the sector, we will be speaking with the CEO of Marcus & Millichap next. Later, the commercial real estate market is still reeling with the aftermath of the pandemic. The rise of hybrid work, higher interest rates, and also mass layoffs posing a series of challenges for real estate executives, but also for the bank loans tied to them. With more landlords dealing with vacant properties, banks are starting to increase reserves for future losses, while some investors choose to pull out or seek alternative strategies of commercial real estate funds. Here to weigh in, we want to bring in Hassam Naji. He's Marcus & Millichap's CEO. Hassam, it's great to have you in studio. Thanks for coming in.
Thanks for having me on. Great to be here.
So let's talk about where things are, where things stand today within commercial real estate. I think a lot of investors are trying to figure out whether or not the worst is over, if the next couple of quarters is going to remain challenging. What do you expect?
Well, broadly speaking, we've had 4 years of ups and downs that equate to what would normally occur in a 10 to 12 year cycle, from the pandemic itself to the very, very sharp recovery post-pandemic, and then 2 years of Fed tightening in ways we haven't seen since 1980. That's a lot to digest for an industry that is very interest rate sensitive and very supply demand sensitive. So on the supply demand side of the equation, which is the most important part, the industry as a whole is doing great. We haven't overbuilt in this cycle. There are pockets of overbuilding in multifamily and industrial, but broadly, we are not overbuilt. And we are basically under-demolished, if you think about it, in some sectors, like retail was 15, 20 years ago when e-commerce took over, now applying to the office sector. But even within the office sector, it's the older urban assets that are really suffering, showing loan delinquencies, seeing significant discounts of distressed assets being sold into the marketplace. And then the suburban assets, office assets across the country are doing much, much better. Or newer properties are doing much, much better. So there's a lot of generalization that goes on about commercial real estate. It has 16 different branches: self-storage, seniors housing, mobile home parks, retail, of course. Even within retail, there's single tenant net lease, there's multi-tenant shopping centers, self-storage, and of course, apartments and hotels. So each one of these niches has its own cycle, has its own supply demand, and therefore investor demand. Right now, we're seeing a lot of opportunistic capital that's been waiting for the price corrections to start to come back into the market, because we've had 2 years of pressure from interest rates lowering values.
How does the hopefully for investors impending rate cut cycle play into this?
It's a very encouraging piece of news that hasn't materialized just yet.
Yeah.
And what I'm really interested in seeing is the encouragement that we're seeing already with capital coming off the sideline, buying assets at 15 to 20% discounts, which is pretty much what's occurred in the marketplace in general, ahead of the interest rate reduction cycle. It will come at some point. That's only going to boost the activity level that we're already seeing the beginning of the pickup for.
I'm curious what you think this recovery is going to look like, because you're right. As we say, I think a lot of people lump CRE together when there are a number of different verticals within it, right? So it's not a blanket weakness that you can call it across the board. But when we talk about the areas of it that have struggled, what does that recovery look like? And you mentioned some of those opportunities. Where are you seeing the most demand today?
Great question, in that within each of the sectors, that broad brush is creating a lot of opportunity for smart investors. Because as a lot of people went on the sideline, the astute investor was in the market making offers, maybe not executing transactions, but being in the front end of where the prices would adjust to the point where they made sense. If you look at multifamily, for example, we've seen a 20-25% price correction. In most cases, if you just look at on an apples to apples basis from peak to today, and those prices are below replacement cost, it's getting so expensive to build commercial real estate of any kind. And they're below peak by about 20-25%. So when you see a good asset in a market you want to be in as an investor at those price points, you almost don't care about the interest rate. You almost don't care about the fact that the loan that you would take on it would be at a much higher interest rate today than 2.5 years ago, because interest rates will come in at some point, and over the long term, you know that asset is going to do very, very well, and it'll be much harder to replace down the road.
Hassan, thank you so much for joining us. We really appreciate it. That was Hassan
Great to be here.
Naji. He is the CEO of Marcus & Millichap. Thank you so much.
Thanks for having me.
Well, coming up, we've got Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, it's a big week of economic data and the start of a new earnings season. We'll talk to a portfolio manager who will tell you what it all means for your money. And interest rates are at 23-year highs, but the Fed is considering when it should start to cut some rates. So is now the time to invest in a certificate of deposit, commonly known as a CD? We'll get a piece of advice from an expert there. Plus, are you retirement super saver status? No? Do you want to be? Well, we'll tell you what it means and what it takes to save big for the later years of your life. All that and much more coming up on today's show. But first, let's take a look at some of the market action. We're 90 minutes into the start of today's trading activity, and you've got the Dow, the S&P 500, and the Nasdaq all in positive territory. The S&P 500 flat just barely to the upside, as well as the Nasdaq Composite. However, the Dow seeing fractional gains of about 0.4%. Let's take a look at the week ahead. Tuesday, we get a check on how small businesses are feeling about the economy with the NFIB Optimism Index. We'll also hear from Fed Chair Powell as he kicks off his semi-annual testimony to Congress. And then Wednesday, we'll get more testimony from Powell, and other Fed members are going to speak too. Thursday, that's when we get the all-important June inflation report. Consumer Price Index, that's when that's dropping, 7-11. And Friday, we'll get wholesale prices and consumer sentiment. So this week, we've got plenty of economic data. You've got Slurpee Day at 7-11, and then you've also got some earnings from Delta, PepsiCo, and Conagra, all reporting on Thursday. JP Morgan Chase, Wells Fargo, Citi, they report on Friday. So all of this and much, much more. Now, you'll remember Fed Chair Jerome Powell spoke at the European Central Bank Forum last week in Portugal, where he said the U.S. economy is getting back on a disinflationary path. So for more on what the latest economic data could mean for you and your wallet, we bring in our very own Josh Lipton. Hey, Josh.
Brad, we had that big jobs report last week. This week, more important economic data is on deck. This time, as you were mentioning there, the focus is on inflation with the release of the June Consumer Price Index coming on Thursday. Economists expect headline inflation rose 3.1% annually in June. That would be a slowdown from the 3.3% rise seen in May. Prices are set to rise 0.1% on a month-over-month basis. On a core basis, so excluding volatile food and energy items, CPI is forecast to rise 3.4% over last year in June, unchanged from May. Monthly core price increases are predicted to clock in at 0.2%. The Federal Reserve will, of course, carefully examine this CPI print as another important data point determining if and when they can start cutting rates, which affects borrowing costs for consumers and companies across the economy. Remember, there was that string of hotter than expected inflation data to start the year, which surprised our policymakers in Washington. The picture does seem like it has been improving, but central bankers still seem to be feeling cautious. We saw that in the minutes of the Fed's June policy meeting released last week, which investors look to for clues behind the policymakers' thinking. Our central bankers said the progress toward their 2% inflation target had been modest and that they still want more data to give them greater confidence that inflation is indeed returning sustainably toward 2%, adding that some participants emphasize the need for patience. Still, investors bet that inflation it's headed in the right direction. That trend, coupled with a cooling labor market, will give our Fed the cover they need to start cutting rates soon, perhaps in the fall. Markets currently assign a roughly 75% probability of a rate cut in September. Brad, back to you.
Yeah, it's been really interesting to track, especially with regard to how the Fed's thinking could move at coming meetings. And I'm taking a look just at the CME FedWatch probability. A week ago this time, we were looking about 60%, 60 to 65% of a rate cut coming in the September meeting. You look at that now, you fast forward a week at this point, now we're looking at about a 77% chance. So a significant jump even week over week. Some of the ISM data had really swung things and the common consensus thinking last week. We'll see what this inflationary data sets up this week as well.
Yeah, and as you were pointing out, Brad, also our central bankers are back on Capitol Hill. Yeah. You know, Jay Powell in front of lawmakers, we'll see what he says there too. Does he give any more indication? There are some economists who think, maybe at least in July, does he start laying the groundwork for that cut in September? Sure. We'll see what kind of color commentary we get.
Josh, appreciate it. Thanks so much for teeing this up for us here this week, as big banks are also setting the stage this week. With earnings season upon us once again, financials will be in particular focus over the next few weeks. 40% of the S&P 500 companies set to report Q2 earnings over that period will be from the sector. This is according to FactSet. Now, big banks, they've got a high bar to beat after its strong Q1 showing. For more on this, we're joined by John McClain, who's the Brandywine Global Portfolio Manager. Great to have you here with us, John. So let's just set it up. For financials, what is the tune you expect them all to either sing in unison, or how this could be a tenor that sets up the rest of the earnings season once we hear from these big banks?
Yeah, I mean, I think what we're looking for financials is nothing too scary, right? So it's going to be a lot about loan loss provision. It's going to be a lot of commentary around commercial real estate, but expectations are that we're going to continue to see reasonably strong earnings out of the banks here.
And so with that in mind, what is the read-in on the consumer that you expect we can extrapolate from some of these bank earnings?
Well, so what we're going to see from the consumer is a continuation of a trend of a bifurcated market where the wealthy consumer is doing quite well. The liabilities that they historically had are fixed rate, things like mortgages at very low rates, which are actually assets at this point in time. And so the high-end consumer is doing well and spending and earning 5% in front-end treasuries or CDs. The low-end consumer is going to continue to struggle here. I think we continue to see the pinch of inflation and the drawdown of excess savings, and I think you're going to continue to hear that trend from banks.
If we hear from some of these big banks, and I'm thinking notably about what are typically the economic weather forecast updates that we kind of get from those like Jamie Dimon at JP Morgan Chase, where that could have the propensity to spook markets or rattle investors if there is some type of macroeconomic condition that he's sensing, or a symptom of something else that he's sensing that he communicates to the street. Is there anything that's set up to spook investors for the second half of this year, as we're set to hear from some of the CEOs of these large banks?
Well, I don't think you really want to read too much into the reaction function over the coming weeks. It's the summer lull. Liquidity is relatively dry in financial markets, and everybody's really waiting for the election coming up. So I think that we're not too particularly worried about what the banks are going to say and the reaction function at this point in time.
Certainly. Let's talk a little bit about one other major theme that's driven earnings seasons past, and it's been artificial intelligence and NVIDIA, to put a poster child name on top of it. To what extent does this earnings season still hinge on NVIDIA?
Well, yeah, I mean, look, AI, the S&P 500 is effectively an AI index at this point in time. And so we've seen the bulk of the gains being driven by a handful of stocks, and NVIDIA certainly being the poster child of that. So I think there are very high expectations going into their earnings reports. And it's going to be tough to, again, beat. And really, again, where we're sitting with the rapid growth in market capitalization, the rapid growth of the underlying fundamentals of the business, it's hard to continue this type of growth rate over a sustained period of time here. So I think we're looking for potential, a little bit of an underwhelming report from them relative to what is priced into the marketplace.
So if that were to take place, I mean, it's likely that we'll start to see some rotation into other areas of the market. Where does that broadening kind of best position for any investors that are looking to kind of take some chips off the table or reinvest them elsewhere? What does that rotation kind of, best benefit at this juncture?
Well, it's basically everything X AI at this point in time. I think, look, the underlying fundamentals of the large cap U.S. economy is reasonably strong here. So I think there's a lot of different places you can look to reposition capital away from kind of the excess speculative part of what we see in AI.
John McClain, who's the Brandywine Global Portfolio Manager. John, good to see you. Thanks for joining the show with us this morning. Thanks. Well, President Biden doubling down on his intention to continue his legacy in a letter to congressional Democrats this morning. This after at least 5 Democrats called on the president to drop out of the race. To discuss what a potential Biden exit means for your money, Yahoo Finance's very own Rick Newman is here. Rick, I mean, you just heard our previous guest, John McClain, talking about how the economy is strong right now, and the Biden campaign and the administration has been trying to continue to communicate that, but it's had little success as inflation is all the talk of the barbecue, it seems, over the summer.
Well, Biden, of course, hopes that will maybe not be the topic so much at the Labor Day barbecues in September because the inflation outlook has been improving. And I think what Biden needs voters to do is just stop worrying so much about the price increases they've seen over the last 3 years. That's mostly been at the grocery store. People who rent have seen it in their rents going up, and of course, gasoline prices. So all these things are going in the right direction for Biden, Brad. I think it's just, assuming he stays in the race, I think it's just kind of a race against time for him over the next 4.5 months. Is inflation going to improve enough so that within the weeks prior to Election Day in November, that's not the main thing people are talking about? And he can't jawbone this away. It just has to be something that consumers start to feel better about organically.
And so, Rick, for the internal workings of the Democratic Party right now, Biden putting this letter directly to those members of Congress who are pushing for him to step back or step aside and allow someone else to really carry the mantle. What are we expecting to actually net out here?
Well, President Biden is going to insist he is staying in the race until the very second that he changes his mind. I mean, the moment Biden says, well, maybe I will withdraw, I'm going to give it some thought, he's dead in the water the moment he says that. He might be dead in the water anyway, but he's got to, he's got to be in it to win it until he decides otherwise. So for everybody who hears Biden saying, I'm not going anywhere, he has to say that. I think really the thing to watch at this point is, do we see mounting calls from even more Democrats, and especially the name brand Democrats whose names ordinary people might know? That would be Chuck Schumer, the Senate Majority Leader, and Hakeem Jeffries, the House Minority Leader. So he's the top Democrat in the House. They have not said anything publicly suggesting Biden should withdraw. They have been a little bit on the fence. Some of these people, Nancy Pelosi, for example, former House Speaker, she said, well, what voters need to know about Biden was what everybody saw on the debate on June 27th. Was that an episode or a condition? That's a pretty good way to think about it. In other words, was it just a one-time thing, or is Biden just foggy on kind of a regular basis? So watch for more prominent Democrats coming out and saying he needs to go. That would tell you which direction this is headed.
Would a Biden withdrawal affect financial markets?
Investors are really scratching their heads over this because markets are beginning to price in what seem to be the probabilities of either a Trump Republican victory or a Biden Democratic victory. So markets are trying to figure out, well, if Biden's not the guy, if it's somebody else, the two questions to ask there. Number one, does it change the probability for one party or the other? Would it make Democrats, would it give Democrats a better shot than if Biden stays in, or a worse shot if it's somebody who might seem like an even weaker candidate? That's number one. And then once markets digest that, they have to figure out, what about specific policies that we have to care about? And there's a lot to care about here. One of them is tax policy. There's going to be a big difference between what Democrats and Republicans do when all of the individual tax cuts from 2017 expire at the end of 2025. So something has to happen there. And then Trump has these couple of wild card things, which is, mostly tariffs. And he wants to go around finding illegal immigrants and throw them out of the country, this mass deportation thing, which would have economic implications. So there's a lot here for markets to digest, Brad. I think we're seeing small movements now, and I think we're going to see bigger movements in markets with regard to stocks and also interest rates, betting on inflation going up or down after the election. We're going to see more knee-jerkiness once we get within a month or two of the election.
Rick, just lastly, while we have you here, because you triggered another thought here for us too. Say some of our viewers are part of the listserv, and they get these texts from either campaign, whether it be from Biden, whether it be from Trump, and they donate this money. And in this specific case with Biden, what happens to that money that they did donate?
Well, if you're a billionaire who has given $10 million to some super PAC, you should call up whoever's running the super PAC and say, hey, I want to know what happens to my money. Most people are not giving $10 million, but a lot of people are giving $20, $50. So those small donations, they don't go to super PACs. They go to the political campaign, the Biden-Harris campaign fund. And what happens to that money depends on if Biden withdraws, who takes over. If Kamala Harris, the vice president, takes over and she becomes the nominee, then all of the money, including all the small dollar donations that are in the Biden-Harris campaign committee, she gets control of that because she is listed as a part of that committee. If it is not Kamala Harris, then that money could go to other uses. It becomes what's known as excess funds. It could go to the Democratic National Committee. It could go to other political committees. It would stay within the Democratic universe. And just important to point out for anybody who's wondering, Joe Biden cannot convert any of that money to personal use. He can have a say in what other political causes that money might go to. But if Kamala Harris becomes the nominee, then she would basically get it all.
All right, Rick Newman, thanks so much. An extended Rick Newman hit here on the day, covering a wide range of topics, all surrounding what's taking place with President Biden right now. Thanks so much, Rick. We've got all your markets action straight ahead. Stay tuned. You're watching Wealth on Yahoo Finance. Interest rates are currently at a 23-year high, but the Fed is considering the timing of its first rate cut here. The majority of traders think it'll come in September, so it might be time to look at your portfolio to identify the rate-sensitive areas. Examples include real estate, bonds, high-yield savings accounts, and CDs, among others. Now, right now, plenty of banks are offering rates on CDs of 5% or more. But how does the Fed's policy decision play into those rates? Here with more is Mark Hamrick, Bankrate Senior Economic Analyst. Mark, great to have you back on the program to speak with you on this. So, first and foremost, just the correlation that people need to remember and keep in mind between CDs and the Fed's rate policy here. What is that direct correlation?
Good to be with you, Brad. Well, first of all, let's just sort of capture where we are right at this very moment, because there's so much appropriate attention. I think most of it's appropriate on what the Fed might be doing later this year. But the reality is that we have a policy setting meeting at the end of this month, and the Fed is not expected to change its benchmark rate then. So we're really talking about expectations down the road. And if the experiences of the past days, months, and years have meant anything, we're living in times of a great amount of uncertainty. So first of all, rates are still at high levels, and that's a tremendous opportunity for savers, depending on their investment horizon, the amount of time they can allow money to be parked, and whether it's a high yield savings account, a 1 or 5 year CD. Americans are undersaved, and so these are good products for them to look at. In terms of the simplest way to put it is that the Federal Reserve sets the tone for the interest rate environment, broadly speaking. Some of these things are more tightly correlated to what the Fed does than others, but broadly speaking, if the Fed begins to move interest rates substantially lower, then we would expect the rest of the rate environment, broadly speaking, to follow suit. But we're really talking about the expectation, Brad. The rates are falling like a feather, not a hammer. And so even if we get that 1 or 2 rate cuts by the end of the year, as so many people seem to be confident about, we're still talking about rates remaining at relatively high levels.
What should a saver's time horizon look like if investing in CDs?
Well, really, it boils down to what are their demands or needs around that money. And so, with barely a little more than 40% of Americans able to pay an emergency expense of $1,000 or more from savings, this is not everybody who's watching this telecast, but it's a big part of the American population. More people need to be saving. And for that part of the population, much of that needs to be available at rapid notice. So for those people, a 5-year CD is not a great option, but for people who really do want to park that money and have the guarantee of let's say, a 4 or 5% return on that over 5 years, they have a high degree of confidence that they will not need to withdraw that money and suffer the penalty for early withdrawal. For others who say, well, I might need the money, I might not, a high yield savings account's a good option. For those who have a high degree of confidence they won't need the money within the next 12 months, a 1-year CD is a good option. The yields are relatively high on all of these things. And so what I would say is much the same as with market timing. Don't focus so much on trying to nail the peak on rates with respect to CDs, et cetera. Just get in the game. And so being a long-term investor is somewhat aligned with being a long-term saver. If you're in the game, you're going to benefit.
And certainly. And now, as we're thinking about some of the other investments that are most notably impacted by the federal funds rate, where are other areas of exposure that could have a significant hit if we were to see that first rate cut come through and a broader pathway for more rate cuts come through?
Well, I don't know that that's where our focus really is, Brad. I think the focus probably needs to be more broadly on the performance of the macro economy. And so, here we are just a few days out from the monthly jobs report that could, and that is just in capital letters, could have represented something of an inflection point in the sense of, well, this was a little weak beneath the surface. Are we going to see more weakness in the job market in the coming months, or will it continue to sort of be consistent with the theme that we've seen really for several years now, and that is resilient and sustained stability? We just don't know the answer to that. And so, it depends on the investment time horizon of individuals. If they think that this money that they have in wherever it's parked, if they can't afford to take a bit of a hit in the near term, then, that's a question about having a conversation about sort of where your investments are allocated, whether you need to dial down risk. But for most of us, we're invested for the long term for the purpose of saving for retirement. And, market timing on that has generally been a fool's errand. So again, being in the game rather than trying to nail it on a day-to-day basis, if anything, I think a lower interest rate environment going forward could speak to better prospects for improving market breadth, because some some of the interest rate sensitive sectors have been the ones that have really suffered in a high rate environment. If we have an environment where rates are coming down, then it feels like those rate sensitive sectors are able to stabilize and perhaps be a bit more productive.
Mark Hamrick, who is the Bankrate Senior Economic Analyst. Great to have you here with us on the program. Great to catch up with you, Mark.
Always a pleasure, Brad. Thanks for having me.
Certainly. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Wealth on Yahoo Finance. "44% of American workers are retirement super savers, according to a 2023 Transamerica study. But what is this super saver, and how can you become one? Here to break this down, we've got Ted Jenkins, who's the Oxygen Financial CEO and Certified Financial Planner. Ted, great to have you here on the program with us today. What is a super saver? Let's just start there.
A lot of people are asking this question, Brad, but generally speaking, it's people that save 10% or more of their salaries if they get a company match at work. It can be close to 15%. And interestingly, in the first quarter, Fidelity found here in 2024 that the average savings rate into 401ks was 14.2%, which is close to that 15% target. What's ironic about it across the generations is that Generation Z has the most amount of super savers, and right now, Generation X has the lowest amount of super savers. I think between the kids and their parents and taking care of both, that's what's making it lower for them.
What are the common traits of a super saver?
Well, the biggest thing is they're just not susceptible to lifestyle inflation. They use something called the rule of thirds, which means every time you get a pay raise at work, about a third is going to go to taxes, a third goes to fund, and then a third go to additional savings. In addition, a lot of these super savers now automatically enroll in their 401k. It's roughly 60% of all new enrollees in 401ks. It's automatic, and they have increases in savings on an automatic basis. And then last, they have mentors, whether it's in a group or you have a financial advisor or one-on-one, somebody to talk about money, savings, and things like that.
And so everybody wants to become a millionaire or have $1 million or maybe more. Why not more?
Right.
How long does it take to become a millionaire if you're using that 401k and the max kind of matching that you can get?
Well, unfortunately, Brad, there are no microwave millionaires in America. For all the time that I've been doing this, it takes people about 26 years to become a millionaire in their 401k at an average savings rate of 17%. And that's with the reasonable rate of return and making sure that they don't pull money out of their 401k. That being said, still less than 2% of all Americans are millionaires in their 401k. So we have a long way to go, but it takes roughly a quarter of a century to get there.
You know, it's interesting, as we were looking through this survey and some of the findings here, it really comes back to, for retirement savings, how many people are actually going above and beyond and how many are not able to put away enough, whether they've been hit by the pandemic and that tapped them, or whether there is a medical issue that they've had to deal with. There can be so many different factors, but is there a retirement savings crisis that's looming right now?
You know, Brad, I think there is. As exciting as it is to talk about super savers and people being millionaires in their 401ks, we still have a major gap in wealth here in America, because that means 56% of people aren't saving 10%, and some of those people are saving zero. And while Americans have 1.2 trillion in credit card debt, half the people in America have not made a repayment to their student loan since last October, and auto delinquencies that are at a 20-year high. We have a real problem with people being able to save here in America. You know, I used to tell people, Brad, that retirement was sort of a three-legged stool. You get a pension at work, you get Social Security, and then you have personal savings. Today, Brad, I think that's turned into a pogo stick. It's directly on the shoulders of Americans to save for retirement, because who knows about Social Security, and certainly companies don't give out pensions anymore.
Yeah, well, we certainly got to change some of the inputs to remediate some of the wealth gaps and equity disparities as well. Perhaps that would put us on a better track also. Ted, thanks so much for taking the time here with us today. Ted Jenkins, Oxygen Financial CEO.
Thanks for having me, Brad.
Certainly. Only 11% of couples retire at the same time. This is according to an Ameriprise report. And with that comes some complications, like changes in spending habits. To discuss, Yahoo Finance's very own Carrie Hannon is here. Hey, Carrie.
Hey, Brad, great to be here. Yeah, this is kind of interesting to note because there's been a dramatic shift. And just a quick bit of history. If we went back 2 decades, most couples, there was a primary breadwinner, and when they retired, it was pretty simple to figure out what spending in retirement would be like. You could maybe bump it up a little bit the first 2 years to have some fun, but then everything settled down to kind of steady Eddie. But as dual career couples have emerged as the most common thing in American families, we've got these dual career couples, and they're not retiring at the same time. So one might still be, pedal to the metal, the other's retiring. And so it becomes a bit murky on how do we figure out how do we get a grip on spending in retirement? And so JP Morgan Asset Management also did this very interesting study that really pushed and looked at the volatility that they're seeing in spending. So what across time, they see these surges in spending. So couples or households are spending surges, then it downshifts, then it upshifts, then it downshifts. And by volatility, they're talking about a 20% shift in spending one way or the other. This makes planning super difficult. So, what happens is if you do have that big spending surge right at the beginning of retirement, you're pulling away from your retirement accounts. And if you're going to live for 3 more decades, good luck, right? So you need to be very conscious. The old 4% used to be the rule, the tent pole. It still is, of how much of your retirement savings you can pull out each year in retirement. But with 2 couples retiring at different times, this all gets a little bit complicated because, they almost feel like, hey, we've got 2 incomes now. Let's just keep rolling with spending. So what has to happen here is, there are ways to kind of get a feel for this. And I encourage people, sit down before one of you retires. This is very possibly going to happen in your household. Let's talk about what spending might be like moving forward. And it's a pretty fraught issue. People hate to talk about this. So if you can get couples to kind of get on the same page about, okay, I am going to be planning on spending a bit more. You're still working, but we need to manage this. If possible, get comfortable with the idea of spending in retirement. I mean, people often go into a panic about the idea of spending in retirement. This is on the other side of the flip side because we're so conditioned to save. So you want to also work on ways to get rid of that fear of spending as well. So it's 2 sides of the coin: conversation, communication, and getting at ease. I often, I really think it's important if you can work with a financial advisor that's unbiased to help you kind of even out these spending. Plan for the surges, perhaps, if that's what you need to do. And if you think you're going to have these upswings, then by all means, try to push back taking Social Security to the latest date when you're age 70 and get the biggest bang for your buck in your check moving forward.
Carrie, excellent layout there. Appreciate it. Thanks so much.
Thanks, Brad.
We've got all your markets action ahead, plus even more of your personal finance wealth building coming up on the other side of this short break. You're watching Yahoo Finance. Homeowners' equity has reached a near all-time high. This, according to new data from CoreLogic. For more details on what it can mean for the housing market, let's bring in our own Rebecca Chen. Hey, Rebecca, what can you tell us about this data?
Hey, Brad. It's good to be here. That's right. So we're seeing that homeowners are building a lot of wealth through their homes. And from this CoreLogic report, we saw that the average U.S. homeowner gained about $28,000 over a year on their houses alone. Homeowners now have about a little bit more than $300,000 in equity through their real estate, and this is a near record high. Collectively, U.S. homeowners with a mortgage now has a $17 trillion of tappable equity sitting on the market right now. And I do want to highlight a little bit of what is going on through the states. We saw that in this report, we saw that California, Massachusetts, and New Jersey has seen some of the highest and most robust homeowner equity gains throughout the last year. For example, California alone, the average homeowner there had a $64,000 increase in their housing wealth, whereas this number was $61,000 for homeowners in Massachusetts. So as we can see, these are quite an amazing increase over the past year, I would say. And I do want to provide a little bit of context of what home equity is. And that is what your home is worth minus the mortgage you owe on this house. So for example, if your house is worth $400,000 and you owe about $100,000 of mortgage on this house, your tappable equity or your housing wealth is $300,000. And that is yours. It belongs to you. When you sell the house, you get to take that with you. And the reason why housing equity has been gaining at such a pace is, of course, due to home sale prices. As we see home sale prices increase, the owner's wealth definitely increase along with that. So even though we have seen, or some data is showing that the gain in home prices is slowing down, homeowners did already and have and continue to see a great increase through their housing wealth.
And so, Rebecca, mortgage rates, they continue to remain high here. What kind of impact does that have on tappable equity?
That's a great question, Brad. One of the experts I spoke with said that even though homeowners' equity is at a near record high, it doesn't mean it's easy to tap into their equity right now. In fact, housing experts are sharing that they're seeing a lot less homeowners taking advantage of their tappable equity. And the reason is because mortgage rate has been so high that borrowing cost is too high to, take any additional loans or mortgage out from their house. We also talked to another expert who said that because mortgage and housing prices are so high, it's a little bit more difficult to use your equity these days because if you sell your house and get another one, unless you pay all cash, the mortgage rate, your financing cost is going to be a lot higher. So definitely not as many people are taking advantage of this right now. So, experts really just recommend that if you want to tap into your home equity, definitely look at your circumstances and what makes the most sense, because we are in a relatively high mortgage rate and interest rate environment right now.
Certainly. Rebecca Chen, thanks so much for really extrapolating all the details from this CoreLogic study. Appreciate it. The great wealth transfer is supposed to take place in the coming decades, with baby boomers passing along about $84 trillion in assets to millennials, according to a Citizens Bank survey. Our next guest says that millennials are not ready for this influx of cash. Here to discuss why and tell us why is Sal Buscemi, who is the Brahmin Partners co-founder and managing partner. Those are fighting words for me, Sal. I'm a millennial. I feel like I'm kind of ready. I might not be fully ready. I still want my family members to be around, of course. But how can we be more prepared, perhaps, than we already are?
Hey, Brad, thank you very much for having me here. It's a pleasure and a privilege. To be frank with you, the millennials, as far as the wealth transfer that we're seeing at the higher levels, meaning the top 1,000th of 1%, there's usually strategies in place with these families to make sure that wealth moves over in a meaningful way. But when you're looking at the middle class and you're looking at 401ks and other things like that, I think what you're going to see is that they're not prepared for it. But I don't think that is really going to take the beneficiaries, meaning people like yourselves, the millennials, that far going forward with the way inflation has been ripping for the past year and a half at least.
Where is the majority of that wealth transfer in terms of the types of assets that we're expecting to transfer over? Where is the majority of that kind of sitting right now?
Majority of that, at least that I look at, are in real estate, commercial real estate mostly, and of course, real estate all over the country. But it also resides too in private equity and venture. You're starting to see private credit, meaning instead of people going to a bank for a loan, they're going to wealthy families, and there's these pools of credit that are available that allow people to sort of insulate themselves from risk in a different way to be able to participate in a different way as far as income streams are concerned. And then there's also the stock market too as well, and that's mostly driven by middle class savings and 401ks and other tax advantage vehicles, and that'll send over. And I think don't forget that Uncle Sam's going to want his cut of the take too before that transfers over as well. It might not be the most efficient transfer, but he's waiting there with his hand out.
Yeah, always seemingly. So for actionable tips that people can start to put to work right now as they're having their own family financial planning, what are some of the actionable, perhaps 3 ways that people can start talking about the great wealth transfer at the dinner table, over phone calls, at family events, so that they can better position themselves?
It's a very good question. It's also a very emotionally charged answer. And I think the sooner that you have the details up front with who's getting what and how much, that would be great. You don't see that very often until it's post-mortem in a will, and that causes all sorts of contention. Number 2, I would advise everybody here to really get their own private wealth advisor beforehand, so they know what's going on, so that there's going to be a smooth transition, because you are going to need someone to hold your hand through this process, especially when you're dealing with, for some, would be lottery sums of money, millions of dollars being transferred to them. And then after that, what you have to really do is prepare to yourself before you do inherit all of this. What do you want to do with it? What are you looking to do? Are you looking to put your sons and daughters through college? Are you looking to start a business? Are you looking to do something with a foundation, or something perhaps as it relates to charity work? And that's really something that a lot of people are always thinking about. It's like, once I have this wealth, what do I do with it next? And depending on your personal needs, you can take it very far.
All right. Sal Buscemi, who is the Brahman Partners co-founder and managing partner. Great to have you here with us today. Appreciate it.
Thank you, Brad. Thank you.
Certainly. Less than half of women are confident about their finances, but 94% of women believe that they'll have to be personally responsible for their finances at some point in their lives. This is according to a Bank of America report. To discuss how women can feel empowered about their finances, Lacey Garcia, who's the Willow founder and CEO, is here with us. Lacey, great to have you on, especially on this important topic. So let's begin with why this certainly is the case right now and where we're starting to see it shift a little bit.
Thank you so much for having me on. Pleasure to be here. Well, I just heard your former speakers all talking about the great wealth transfer. And first and foremost, women are the greatest recipients of that great wealth transfer, not only as spouses, but just talking about millennials, but also the daughters. And also women are starting more businesses than any other cohort, and are creating wealth and really the breadwinners, and half or more of all homes in the US, but they have not historically felt that they were understood or empowered by the financial services industry. They have felt that they have not been able to take control of their finances because they haven't been able to find an advisor that they trust. And that's what we focus on at trustwillow.com, making sure advisors understand the unique needs of women and that they are able to empathize, educate, and empower them to take control of their finances, but also to achieve their life goals as well.
When you think about that too, and you mentioned Willow, of course, is leaning and is purely looking at the financial technology landscape and really discovering where you can play even more of a role into making sure that women have that financial independence too. What are some of the top planning techniques that many women are looking to put into action when they come and engage with Willow?
Yeah, I think that, first women are coming to us, or not just women, but also next gen investors and underrepresented investors, those who haven't felt like they've been able to find the advisor who understands them, are first and foremost looking for that trusted guidance and advice. But thanks to technology, and obviously we use AI to actually strengthen the ability of advisors to connect with investors and to support them. And there's so many technology and tools out there to help, not just women, but all investors to better budget, and have a better sense of, first of all, what is my life cost? How much money am I spending, and how much money do I need to save? And so those tools are there to help to empower them, and also to help them to find the right financial professional who can provide that trusted guidance and advice that they need to feel, confident and in control of their money, especially in these uncertain times that we're living in.
It's really interesting. In one of our earlier segments as well, we were mentioning and kind of concluding with the thought that, some of the planning also becomes a little bit easier or more confident when we're doing more work to also close the equity and the pay and the wage gap across genders too. Where are you seeing even more of that work continue to be done, and then ultimately kind of remediate some of the stresses of financial planning?
Yeah, so I think what's really critical is that, the industry needs to understand that for women, for underrepresented investors, that these pay gaps have existed, that, the challenges that create a big gap in their ability to save for retirement and the amount of money that they're earning over a lifetime. And then to be able to really create not just products, but also strategies to make sure that women and younger and next gen underrepresented investors are able to then, achieve the retirement income that they need, but with an understanding that they start from, perhaps a place of disadvantage, right? And so that's really critical. And, the industry is starting to pay attention, but that is our focus too, and making sure that advisors really understand the circumstances. They understand, how they can truly support these investors in being able to, save enough money to invest properly so that they are able to set themselves up, for success in retirement and for taking care of themselves and their family throughout their lifetime and beyond.
Lacey Garcia, Willow founder and CEO. Thank you so much for taking the time here with us. Appreciate it.
Thank you, Brad.
Certainly. Coming up, everyone, Hurricane Beryl makes landfall in Texas. How the homeowners can protect themselves in this situation. That's next on Wealth. Hurricane Beryl now downgraded to a tropical storm as it touches down in Texas, but still brings hazards from intense wind and rain. So how do you protect your home from a situation like this? Joining me now is Don Griffin from the American Property Casualty Insurers Association. Don, thanks so much for hopping on with us to discuss this. Of course, first and foremost, there is the human element of this, and we hope that everyone out there who's able to tune in is safe and making preparations accordingly. For those who are trying to wrap their minds around the necessary insurance that they'll need for an event like this, especially as we're seeing it pass over Houston right now, what do they need to be keeping in mind at this point?
Sure. The biggest thing they can keep in mind, if they have time and if they haven't done so already, and if they have time before it hits, it's a great idea to walk around your home and take a video of all the things in it with your phone. If you have no other way to do it, or if you haven't got an inventory of some way, that's the first thing. Well, that's the second thing. The first thing is make sure you're safe and you get out of harm's way when you can. So make an inventory. That's key. Take your if you have a lot of companies have apps for their insurance. If you have that information on your phone, that's fine. If not, please at least grab your phone, your policy, and take it with you. So you have it with you when you go, and how you get prepared. If there's still time, you can board up anything you can save to save the windows and save anything that gets save the water from getting in or elevate anything that way. There's a lot more you can do, but I guess the biggest thing for now is to make sure you have those pieces of information with you and some video of what you have so that you can be prepared when you go back.
Certainly. How long should homeowners be prepared to wait for a disbursement or a payment after a claim is submitted?
Yeah, that's an interesting statement. When there's an event like this, one of the things that everybody tries to do, the companies try and do, is they try and get people there as soon as they can. Part of that depends upon the safety of getting the claims adjusters into the area. Also being able to adjust the claims on the spot. Many companies have mobile trucks, computers, and things, and as long as they have hookups and can get internet service and can do things that way, they can oftentimes issue a check on the spot, at least for the temporary living expenses that you might need, or some of the immediate damages that need to be repaired to prevent further loss. But it can be a very quick process depending upon your level of damage, or it can be a very long process perhaps if the home is completely destroyed.
We know that NOAA has been tracking year over year some of the billion-dollar disasters that have taken place, and climate change has certainly led to even more severe weather systems that have moved through that we've had to continue to track the economic damages of. How are we seeing insurance kind of adjust and homeowners as well try to kind of take that into account when they are selecting the policy for them?
No problem. I appreciate that. Climate change is certainly something we're concerned with. But what we're more concerned with is making sure that people have the right coverage for when the event occurs. And that's going to happen, whether it's related to climate change or not. What we have seen is a lot more frequency and severity in the past few decades related to the financial loss that people sustain. And the number of and the intensity of these kinds of events. The key is to, I think for most people, is to make sure they have the right coverage and to make sure that they can get back to their homes in a safe way before they go back. The right coverage would be, you need to make sure in this case, whether you got windstorm or flood insurance, those are key. Particularly in the Houston area. I lived in Houston area for about 9 years myself, and worked in between Houston and Galveston, and so I know that particular area can get hit very hard with these storms. What we're seeing is they're being hit more often, and that's the problem.
Yeah, certainly. Don, thank you so much. And I join you as well as many other viewers out there potentially that do have family and friends that are in that area. So let's continue to check in on them during this time as well. Don Griffin from the American Property Casualty Insurers Association. Thank you so much for taking the time, giving people some actionable tips.
Appreciate the time.
Absolutely. Everyone, that does it for Wealth here today. I'm Brad Smith. Thank you so much for watching. You can stay tuned. We've got even more Yahoo Finance coming your way. Market Domination with Julie Hyman and Josh Lipton starts at 3 p.m. You don't want to miss it.